Message for the White House, because the White House got really angry with Chevron. Remember that yesterday, saying, how can you invest in share buybacks? You should be investing more in production. And if they come out with disappointing earnings, perhaps they could say, look, we're doing what we think is right with the market and, bugger off.
The production, okay, if we could say that on radio, the production part of it, I get. I mean, take the money and run it into production. Why don't you do that? But there's a whole green issue, ESG issue, and there's also just the issue of, is it just going to be a pure share buyback? The last 10 years, Chevron, 9.6% return per year. John Farrell, he's always upstream and downstream, the River Thames, moving from football match to football match. Fulham, I believe, is upstream, Lisa, okay? And West Ham, Fulham is here, and West Ham is downstream. Did I get that right, John?
I guess just about, if you meant West London versus East London. Yeah. I think that's what you meant, but Tom, I guess I'm trying to make a career out of translating what I think you mean. Tom Keane, thank you. I'm Rita Sen co-founder and head of research and energy aspects alongside me in London. And Rita, great to catch up with you.
Thanks.
It's fantastic.
Great to see you in person.
Tom just went through the Chevron numbers with Lisa. $75 billion buyback announced in the last couple of days. I think across a handful of firms, $200 billion of profits last year. It's not bad. Can you tell me whether those CapEx decisions have changed, and are they going to change anytime soon?
No, the answer is no, I think. And, Scott Sheffield said this as well, through and through. Regardless of where oil prices are, these companies are not particularly keen on investing. And dare I say, I don't think we can fault them, because investors don't want them to invest. Investors want them to be focused on ESG metrics, even with energy prices where they have been. And that's exactly what they're doing. They're giving back pretty much to shareholders, and whatever investment they can do is in green energy.
Well, let's talk about where energy prices have been. We had triple-digit crude with China locked down. If the US goes into recession, can we still have triple-digit crude?
I think so. I really believe this is Asia's year with China reopening. Demand was down over 1.5 million barrels per day just because of, from China, right? Yes, we grew by over 2 million barrels per day last year. But when China opens up, all of Asia is going to go with it in terms of the effects we're going to see with travel, with exports. I think that is going to be more than enough to offset US recession. We already have US recession in our numbers.
One question we explored earlier this week was the commodity intensiveness of this China reopening. One person suggested to us they don't think it's going to be that intensive. Are you taking the other side of that?
Look, metals-wise, we've already seen a pretty big pickup, and I'm not an expert to comment on whether the metals intensity is going to be the same. But from an energy point of view, we are already starting to see them buy. Look, given how much refining they need to do and how much storage they're building on, I'm very happy to take the other side, that their imports are going to be up at least 1 million barrels per day year on year.
You mentioned the supply backdrop. How vulnerable is the supply side of things coming into 2023?
For me, the fact that there is no SPR, we've released 220 million barrels last year. That was effectively the supply that came to the market. OPEC is kind of maintaining course right now. We are not far away from a big deficit. I think the deficit happens really in the summer, not right now. But right now, it's gasoline, it's diesel, things we pay for, incredibly tight. And it is going to be a very, very tight products market that translates into crude in the second half of the year.
I've sat through a week of optimism, constructive views about Europe, and Europe escaping the worst of it through this winter. You're smiling, so let's build on it. Did Europe escape a bad winter because they got lucky with the weather, or because they fired up coal?
I think it's a bit of both. I really do think the weather helped, right? If it was as cold, this week hasn't been warm. This week has been relatively cold, but it's been in spurts. If it was a genuinely cold winter, I think Europe would have still been in a little bit of trouble. But yes, coal helped. People have changed behaviors, right? A lot more people are talking about we wear jumpers at home and keeping the temperatures down. That has definitely helped. But the reason I'm smiling is I also think European policymakers are probably being a little bit smug right now. We still have next winter to get through. I just don't think we should be like, okay, we've solved the problem.
Well, let's talk about that, and whether that smugness is misplaced, if you want to call it that. Through last summer, we were building up storage, and we had the benefit of Nord Stream to build up some of that storage at reduced levels, at reduced capacity, I know. Can they repeat that act this year without Nord Stream? How on earth are they going to do that?
And with China reopening, because China's not an oil story only, it is going to be an LNG story as well. And I think that's where I come back to, look, yes, it's justified why prices have come off right now. But to expect these prices to remain for the rest of the year, that's where we would disagree.
You've got to forgive me for asking a calendar-based question, but I will ask one. When are people going to start caring? Because the front page that I've read throughout the whole of this week is sure it's cold, but Europe's escaped recession, Europe's escaped recession. When are the people that you talk to going to start caring about the things that you're talking about?
I really wish they already started caring about it, honestly, because again, it becomes very short-sighted. And I also think it's too soon to say we are going to avoid a recession because industry doesn't come back that quickly. Yes, I absolutely don't think it's going to be a severe downturn, but we are, I mean, look at the layoffs that's already happening in the tech sector across US and Europe, by the way. It will have an impact on growth.
So will you say tough winter ahead for Europe this year, regardless of where the weather might go, based on the fact that it's going to be tremendously difficult to build up storage in the same way they did in the last 6 months because there's no Nord Stream and China's reopening? Is that just the base case, tough winter ahead?
So I would say, yeah, for the next winter, not this winter. And it will depend a little bit on what happens with China and how much China buys. But our base case is that China is going to come back pretty strongly. So yeah, look, again, we're not expecting a repeat of last year, but we would also very much caution that this is not going to be status quo forever.
Amrita, this was great to do this in person.
Thank you.
Fantastic. It's nice to see you. Amrita Sen there of Energy Aspects. TK, you heard it. I think that's a worry that a lot of people have. They are, yes, better off with the winter we've just had in Europe, but ultimately, can you repeat the act next winter?
And I think things have really changed here. Overnight, John, I assume you didn't see it. General Hodges, formerly with the U.S. Army with some real military experience on Europe, wrote a blistering article on the options Ukraine will have with tanks. So I think the military overlay changing with the new staffing of their material in Ukraine folds right into the energy story as well.
Tom, I couldn't agree more. There was a real reluctance, TK, to provide these things 6 months ago. There was a worry that this would be seen as an escalatory step, and now we're doing that. And now there is a conversation taking place too, Tom, and I'd be looking forward to hearing what Richard Haas has got to say to you in a couple of hours' time about it. A conversation about maybe providing jets as well. I don't know where we are on that, but certainly we're taking steps in the wrong direction in the minds of many that perhaps this could escalate. It
seems to be the jet story, let's call it, in the next conversation as well. John Farrow in London this morning here, and again with futures, a little red on the screen, but we've seen this week. Lisa, to your great comments to George Bory of Allspring, I went back and I did a careful study while John was yammering away with Amrita Sen of the Bloomberg Total Return Index.
Yeah.
Almost a 4 standard deviation move down over a 3-decade look at the price of bonds. You know, huge move. Down 16%, and we've come up 5%, come up 6% as well. My word, there's a long way to go.
Which is the reason why people are looking at this as possibly income over a long term. The volatility has been tremendous. And even what we heard from George Bory, you're not going to get that 16% return this year. And it wouldn't even be full return if you got 16% to get all of the losses of last year back. So how much do people come back? How much new value has been unleashed? But what's the pain that people are ongoing and sitting on in terms of losses?
And that goes to what I talked to him about retirement, and frankly, the Chancellor of the Exchequer's comments about the retired who can't retire for any number of reasons or choose not to retire. That's the next dynamic.
Well, people are kind of hoping that that's the case because there have been a lot of people who've retired who are still spending, and people are concerned that that's created a real labor shortage.
We will see the inversion, really pretty substantial. Wednesday, I'm going to say negative 70 something, now negative 66 basis points. Yields higher, 3.56% on the 10-year yield. Stay with us. This is Bloomberg.
Names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe to 20 to 40% if things go well is sort of baseline.
let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Mitch and Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
When we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Further deterioration in the labor market, we're starting to obviously get a flavor of that.
The danger is we have to go higher in rates, and it lasts for longer than what the Fed is even looking for.
We don't think they're going to cut by the end of this year. We do think early 2024.
It's going to be a recession, but a mild recession, so it's a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow in London, Lisa Abramowitz and Tom Keene in New York. On a Friday to get to Fed Week next week, we readjust. Think about the weekend reading and the view forward. In the backdrop, the overwhelming reality, Lisa, is not stunning, that's not the right word, but just a good equity market pushing against the bears.
Even though you do have a really bifurcated picture of the haves and the have-nots from the earnings that are coming out. We saw yesterday from Visa and MasterCard, for example, spending is down, consumers are spending less. Just now, American Express crossing, their earnings are up and their expectation is up for this year. So again, it's hard to find a cohesive picture at a time of such distortion.
I looked at the Apple dividend stream and share buyback stream. I'll get to that in a minute. I don't want to lose the flow of the program right now. But there's the headline, American Express to boost quarterly dividend by 15%. That doesn't sound like recession policy.
But then you look at an Intel and it looks like recession policy, and you look like a kitchen sinking of the whole affair. So at what point do you get a signal versus a noise? Who is the mainstream? Who is the zeitgeist at a time where you've got idiosyncratic stories that are telling such different narratives?
Colgate-Palmolive out as well with a little bit of a revenue beat. We'll get to that here in a moment. 'Cause our big problem here is we're so focused on like 12 names. Apple. Should we do Intel? It's a small cap.
Exactly. Well,
we're as guilty of this as anyone.
The big picture here is that people are feeling optimistic, not just about the U.S., but more so international. And the thing that really stands out to me is the consensus suddenly that Europe and emerging markets are going to outperform and can continue to, even though you've had a rip-roaring beginning of the year. That is the question that I have over the weekend. When do you know it's gone too far? When has that optimism run into a bit of a headwind of perhaps a reality that isn't as real.
And before the data check and the brief to get to our wonderful guest today, I'm looking at sterling, and as John has mentioned, 103 to 124, sterling ascendant, dollar weaker is a backdrop into February.
Is it about sterling or is it about the dollar? Is it about the dollar weakening and people kind of moving back as they look to get everything ahead? I mean, really, at what point do we have an understanding of what's priced in, especially with all the variables still out there, as you've been pointing out with oil and gas and the war in Ukraine?
Red and green on the screen with a good bull market we've had. VIX 23, breaking through 20, breaking through 19. The optimism of 18.88 on the VIX, and the yield space, higher yields. 2-year yield 4.22%. We mentioned the dollar. Brent crude, thank you, Emery, to send for wisdom with Mr. Farrell. $89 a barrel Brent crude.
Yeah, and we did just get Chevron and American Express earnings. We talked about Chevron and their $75 billion buyback. And as we look forward next week, we get Apple, Amazon, and Google all reporting on Thursday. Will that set a different tone? Will that set perhaps a reality check for the previous leadership of this market and what has been a leadership going at least so far this year? 8:30 a.m. the data dump, U.S. personal income spending and core PCE. Core PCE, really important to understand how much the Fed can move away from perhaps a north of 5% Fed funds rate that a lot of people are expecting. Can they do a Bank of Canada, raise by 25 basis points and say, we're done? 10 a.m. we get University of Michigan sentiment survey. Do we start to feel a sentiment among the general population mimicking what we see with financial conditions, mimicking what we see with investors? And do people start to spend more, kind of creating this push-pull conundrum?
I mean, the divergence of claims is one statistic versus Michigan is another statistic. It's stunning. It's like two different worlds.
Well, the claims are not there. And people say it's a distortion. If you've got, packages, when you get laid off from a tech company, you're not going to get counted. But there's something that's not adding up to real pain that some people say has already created a recession that's happened, and we can move on.
Real pain is going to Cannes and stopping by Hermes at the Rue de la Croissant or whatever it's called.
He's talking about
and
Cannes.
Dropping in Cannes, whatever it is. I've never been there, folks. Anastasia Amoroso gets off the Gulf Stream and she's back from a private equity summit. Danny Berger was there. I'm sure you waved and chatted as well. What did you learn in the wonderful atmosphere of Cannes?
Well, first of all,
Genghis Khan. What did you learn from Genghis Khan about private equity?
First of all, no private jets, no Gulfstream, but I did learn a lot about private equity, and specifically, I think a lot of people in the room felt like this is the year to commit. This is the year to commit to investing, because this should finally be the year where we see a reset lower in private market valuations. I mean, Tom, if you look at a private market portfolio through the first half of last year, it was up 4%. The 60-40 was down 17%. And so over the last few quarters, and especially in the next couple of quarters, we should start to see those valuations more meaningfully correct. And if you're a private equity investor, of course, if you're in existing portfolios, you're going to get those marks lower. But if you're just deploying new capital to work now, that means the net IRRs from the downturn years tended to be better for private equity. So for people entering the space, there is a reason to be optimistic.
Within your strategy at iCapital, and this goes for bonds and the guesstimate on stocks, but to keep it on Genghis Khan? Khan. Thank you. I'm learning. To keep it there, is there too much money chasing too few ideas? Are we drowning in money right now, drowning in cash?
Well, first of all, the dry powder for private equity and venture has come down. Some of it has been deployed, but I don't think, Tom, there's few opportunities. I mean, if you look at the market size of private markets, it is 5 times what is available in public markets. Having said that, if you looked at the valuation reset post-08 and post-2015, 2016, I don't know if we're going to get the same valuation reset, because the dry powder relative to that point is certainly much higher. But I think one of the things that is likely to happen this year is last year the deals were not getting done at the tail end of the year because the bid-ask spread was very wide. The companies that were looking to raise funds didn't want to really take a haircut in valuations, and then private equity companies were looking for a deal and they were not getting it. But now that the last funding round has likely run out because it was raised in 2021, I think that's now the time where the deals will start getting done.
Tom raises a great point. There is so much cash still out there. There's all this undeployed capital, which raises this real issue. How do you know when the reset is enough? You say it's not going to be a reset like 2008 because of all of this money. Is the Fed not being successful draining the system of liquidity?
Well, I think they're trying hard, and at least I think they are being successful. First of all, you've seen a massive reset in the public market valuations. I mean, we have this cross-asset look at all the valuations in equities and rates and fixed income, and if you look at fixed income, it is reset to the cheapest valuations we had in 15 years. Not credit, but a lot of the rate side. If you look at equities, we're sort of middle of the road, but think about the opportunities, the valuations that really needed to come down. It's in software, it's in tech, it's in venture, and we have started to see a pretty meaningful reset there.
What about in private markets, though? Because a lot of it hasn't priced, right? It hasn't transacted, so we don't really know. Are we going to see more carnage that perhaps changes some of the optimism that people have now before they even see what that pain is?
So within private markets, there have been resets too. For example, if you look at venture, the reset needed to happen in late stage venture because the valuations have gone like this. And you're starting to see 30, 40% markdowns in some of those valuations, and that's a good thing. The second place where the correction valuations is playing out in the secondaries market. If you think about all the institutional investors that have allocated to private equity, they have not over allocated, but they've allocated a lot, and the private markets, the performance was double the S&P since 2020. So they now have to pare back those allocations, Tom, and as they do, and they sell the secondaries, they're starting to trade, those interests, private equity interests are starting to trade at a discount.
I'm busting your chops about Khan, and the truth is you're in an hour-and-a-half layover in DFW. Everybody's back to work in America. What's the spirit you see out there in America? Is the media overplaying the gloom that's out there?
Well, I do travel a lot, Tom, and now also domestically, internationally, and the spirit is, it is buoyant. I mean, you go through the airports, you go through the lounges. I mean, I think people are gainfully employed, and there's still wage growth to be had. And Lisa, we wonder, why is there not a softer path of retail sales? Because people are gainfully employed. And sure, there's some jobs that may be changing hands, but those layoffs are not resulting in higher unemployment.
Again, though, this makes me wonder how people can have such conviction that the Fed's going to just pause. I mean, honestly, if you take a look at what's being priced in and how much of the enthusiasm we've seen, we've already had this immaculate disinflation is going to basically be cast some cold water with exactly that resilience, that buoyancy that you're talking about.
There's two time horizons we should think about. The one going into next week, which I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish. The Fed is talking about getting to 5% or higher. The markets, if you look at the Fed fund futures implied rates, they're not even getting us close to 5%. So there seems to be a dichotomy there. Near term, I don't think the Fed is satisfied with the pullback in service inflation. Longer term, as you think about 6 months and below, I mean, we now have durable goods deflation on a month-over-month basis, and I think these layoffs will damp the sentiment on wage growth. So in 6 months' time, I suspect we're not going to be looking at 4.6% year-over-year wage growth. It'll be lower.
I got to do a surveillance correction. Okay.
Please.
Mrs. Keene emailed, and thank you, Mrs. Keene, for watching this morning. She says, "You moron, it's croissant, not croissant, the boulevard in Cannes." I said, rue de croissant. And I was wrong. It's croissant.
They were croissants, but
she says my punishment is 4 days there in July at the Carlton. That's my punishment.
We're crying for you.
That will be all right.
That'll be all right. I did okay. Thank you for that surveillance correction. We needed that. It's croissant, not croissant. I'm learning every day.
Yeah. Okay. What's it called again? Just go quick.
Rue de la. Oh, the town.
Yeah.
Genghis Khan.
Yeah,
That's the only way I can remember.
Great.
Seriously.
Nailed it.
Nailed it. I'm going to watch Grace Kelly movies all this weekend. Thank you so much. Anastasia Amoroso with us with important perspective there, and particularly, because, we make jokes about it, but a lot of our guests, including Anastasia, seriously on the road getting the pulse of what's out there. And I would suggest, Lisa, more optimistic than a lot of the gloom that was painted over the last, say, 6 weeks.
I feel like everyone's been optimistic. I feel like over the past 3-4 weeks, the optimism has just been really tangible. And a lot of it is because the circumstances have changed. The facts have changed with the weather and with China reopening. It has changed certain elements of the backdrop.
Enough people are emailing me in from Paris. Croisette, oh my word, I'm going down in flames here. Coming up, a really timely interview. This is Andrew Balls of PIMCO, your Chief Investment Officer. Terrific perspective on the continent of Europe with our Jonathan Farrow in London. Andrew Balls, we'll do that here in a bit. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. There won't be a tax cut anytime soon in the UK. Chancellor of the Exchequer Jeremy Hunt spoke to Bloomberg TV today in an exclusive interview.
We don't have the headroom for major tax cuts, but if I was going to prioritise where I would like to see tax cuts, it would be business tax cuts. But what businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households, it stops them spending, and it puts off businesses from investing.
Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the UK. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. The International Monetary Fund is considering an aid package for Ukraine worth as much as $16 billion. Bloomberg sources say there are still a number of conditions, including endorsement from the group of 7 nations. Ukraine's government would also need to commit to a series of policies. Bloomberg reports that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Economic growth is up, stronger than expert expected at 2.9%. We're growing. Jobs are the highest in American number and the highest in American history. And wages are up, and they're growing faster than inflation.
The President of the United States there talking up where we are on inflation, and it is disinflation. That is a theme for us. Into next week, we're beginning to put together our Federal Reserve coverage. Look for that next week. It's February 1, right?
Yes.
February 1. We're going to have a Fed meeting, and it's going to be really interesting. 50 basis points. Of course, many people nudging to 25. Am I right on that? The consensus now is 25 basis.
Yeah, pretty much. It would be a shocker to markets if they went 50 at this point.
Lisa Bramlett, Tom Keene in New York, John Farrow in London with some good conversations coming up this morning. Red and green on the screen. Headline: the VIX 18.84, and we are ever more accommodative on the Bloomberg Financial Conditions Index, 0.35 positive. Accommodative standard deviation. Right now, we're going to look at wars in Europe and maybe wars within the Republican Party. Maria Tadeo joins from Europe, and Anne-Marie Horton is, of course, our Bloomberg Washington correspondent. Anne-Marie, I guess it's a backstory if you're not in the GOP, but there's a Republican soiree today and vote. And making headlines is the governor from Florida who says, look, it was a substandard 2020, and 2022. What is the level of anti-Trump as the Republicans gather?
Well, I think these comments coming from Governor DeSantis to a conservative influencer, basically two things. One, he's showing that he is putting himself up on this national stage to be a really impactful voice when it comes to who's going to be the head of the RNC. But also he's saying that they need new blood. He wants a new challenger to Ronna McDaniel, and that is Harmeet Dillon, this individual he's backing. And he says this is because, as you outlined, they were not able to deliver this red wave that they forecast in the midterm elections. And he even goes back and says there's other elections we had failed. Also, we should note that Ms. McDaniel, she was promoted by the former President Trump. And what you hear from her challenger is that in the president of this RNC soiree, as you call it, Tom, and this debate on who's going to lead it, if you lose an election, you step down.
What's so important here is that's maybe the war in the Republican Party, but I think off the radar for Americans on this Friday is the war in Ukraine. And Maria Tadeo reporting this morning from Brussels. Maria, I want to just cut to the chase. Each general in America is different. And Ben Hodges is the guy that was in continental Europe, let's call it in Germany, worried about tactical warfare, including tanks in Europe. His comments are stunning on the reach of Kyiv to go after Crimea. Is that even feasible?
Well, if you ask the Ukrainians, they will tell you, Tom, and this we really need to highlight, that this will not get solved. This war will not be resolved in a way that they can agree with and agree to the terms if the Crimea question isn't settled. And Tom, we agree when you talk to officials. There's a public statement, and then there's, of course, the off-the-record stuff they'll tell you behind the scenes. The one thing that I always found is very striking when it comes to Ukrainians is that they will tell you on and off the record they believe and really believe this Crimea belongs to Ukraine, and this question has to get solved and resolved. If they do not get Crimea back, it will be a pause, but it will not resolve the question of the war. Now they feel with the tanks, this discourse of offensive, defensive weapons, that they can reclaim them back. The question is, what about their allies? Will they agree to this? Crimea is a very sensitive subject for Europeans.
I mean, Lisa, the pedigree of our generals, nobody ever talks about it. They talk about when they go to the Pentagon and they got all the brass on their shoulders. How about a young infantry officer who becomes the executive officer #2 for the 2nd Armored Division Forward in Germany? That was a young Ben Hodges years ago.
Someone who very much understands the logistics of war, not just the theory behind it and the gamesmanship. And Maria, I want to go to this issue as we see Vladimir Putin doubling down, even if he can't necessarily win outright. And you see the U.S. and Germany lining up with tanks and with other ammunition for Ukraine. What is the risk, and how much has it escalated, of some sort of great escalation here?
Look, it depends who you ask. If you look at what the Polish Prime Minister Morawiecki will tell you is that a lot of this is bluff and that Russia feeds off that fear. If you show you're not scared of that potential escalation, then of course it will backtrack and they will take a different tone. If you show you're scared, that's when Russia escalates to escalate, hoping that it's the West that will try to make a move and de-escalate. It really depends on who you ask. But I think beyond that, this has been a monumental week from the European perspective. A year ago, remember, we were talking about whether or not there would be an invasion. Germany was ready to send helmets. That was the only thing they were ready to send. This week, a major shift in that coalition. They now have sent the Leopards. This is a massive change in not just the German policy, but also the European. The scale of the action taken is something that a year ago, frankly, not a lot of people would have believed.
And Anne-Marie, in the United States, the situation has changed on the margins in terms of support for some of these efforts. There has been a lot of focus on potential corruption, and there have been the firings of a number of heads over in Ukraine. But there is a voice, a minority that's gaining steam, pushing back against some of the aid. How much is this becoming more mainstream versus still on the fringes?
Well, I think these discussions are going to be a little bit more mainstream in terms of that they will have a seat at the table in the discussions, because when you have the debt ceiling debate and the fact that Republicans want to talk about spending extractions for that, defense spending may come up and spending to Ukraine may come up, because this is something that we've heard from the ultra-right on the Republican side and also some on the left. Not that they don't want to support Ukraine and send aid, they just want there to be potential openings for peace talks. But what you have seen this week is what Maria was talking about with Germany, just sending helmets, now sending tanks. You also saw a reversal of policy from the United States. And what we hear from Ukraine is now they're asking for those long-range missiles, which, to Tom's point, General Hodges says is the only way to capture Crimea. And he says capturing Crimea is really the only way Putin can get out of Ukraine fully. Crimea is always going to be in for Russia to have influence in Ukrainian society and Ukraine's economy.
Anne-Marie Horton, thank you so much. Ladies, lovely to have you back together again. And Maria Tadeo in Brussels as well. I'm sorry, Lisa, I think this is off the American radar. Ben Hodges lights it up here this morning. And I'll just say it as clearly as I can. All of a sudden, this is like war, like from our history books. It's not distant anymore.
Which I think is something that we get lost in, because the number of casualties are also reminiscent of a war from another era. It isn't the usual kind of tactical kinds of bombings and things that are less significant or less sort of hand-to-hand combat in the same kind of way as we're seeing over in Ukraine.
Double surveillance correction? As we go block to block.
What, that Maria was in London?
Maria was in London.
Yeah.
I didn't pronounce it correctly. I got croissant wrong. I think I can get Queen Victoria Street right, but she's in London.
Well, if you're calling it London, you're going to have some other problems. Maybe some bigger problems.
or whatever. Maria today on Anne-Marie Horton with us. Let's talk about the data. Which part of this, equities, bonds, currencies, commodities, floats your boat this morning?
The stock market's been really fascinating to me. The fact that every day we seem to start on a soft
you've done
note.
a great job.
Well, thank you. But we start on a soft note, and then by the end of the day, everyone's rip-roaring excited. So how much can we continue with that, considering that we do get some stories that are not that great? I mean, honestly, what we got out of Intel yesterday, I can't say enough. Yes, this is a PC. This is a personal computer story. But this is also a company that hasn't kept pace with the innovation. You have others like that. Have you fully reset for some of those companies with the sell-off that we saw last year?
As the consumers are just pulling back, Amex forecasts revenue surge after record cardholder spending. That's from Reto, keeper of the Amex.
How much?
He's just sent me a note on this.
How many people who have Amexes, though, it's all for the Delta Lounge?
Oh, well,
I mean, seriously, how many people? I'm not kidding. You can ask.
Bloomberg News
Survey.
reports Reto Gregori, Amex forecasts a revenue surge. Tom, cut it out. Stay with us. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Surveillance. Good morning, everyone. John Farrow in London. I'm Tom Keene. Well, is he in London or is he on his way to Manchester?
London. I think he's in Cannes. Genghis Khan. Yeah. No, he's in London.
If you paint with Farrow and ball paint, then you have to say London. That's how it works.
Nobody says that.
That's a Saturday Night Live thing. Good morning, everyone. It's Friday morning live here at Bloomberg with futures at -11 right now. There's a lot of interesting things going on. Some real nuances of accommodation is seen with the Bloomberg Financial Conditions Index. And Lisa, I'm sorry, this is coming like a train. Brent crude, 88.65. That's a story underneath the story this morning.
And you're seeing that in gasoline prices, and you're seeing that with this question around how much that's going to fuel the ongoing rally that we've seen in energy stocks, with a lot of people saying we're just seeing the beginning of what happens with China coming back online.
Yeah, and off the radar today, and a lot of thoughtful notes into the weekend about thinking about Japan within a Pacific and a global sphere as well. That's a source of reading this weekend is what are the ramifications of 125, 120, strong yen, the flows, what inflation means for the people of Japan and their behavior as you look out to the Pacific Rim. That's another mystery into this year.
As well as what the Bank of Japan will do. Did you see the IMF come out and say, we strongly recommend that the Bank of Japan normalize their interest rate policy? And everyone said, thank you, IMF. I think a lot of people are arguing for the same.
Just beginning to think about the spring meetings of the IMF. Will, of course, have some leadership there, we hope, as well.
Let's get some specific names because it hasn't been all about
season.
earnings.
Let's dive into it.
Let's dive in.
For the next hour
we
Lisa.
We haven't really gone deep into Intel, but I keep looking at 10% drop pre-market, and it's not necessarily dragging down everything with it. You are seeing a bit of a sell-off in Micron and Qualcomm and the other chip makers, but Intel is a specific story that has to do with PCs and the lack of demand there. They gave one of their worst ever quarterly forecasts, partly because of the personal computer sales. You say, you think it's because it's broader?
I don't buy it. Right now, they are 54% off their 2020 peak. This is about the slowdown, the granularity you're talking about. They'd love to say quarter to quarter, baloney. They're getting their clock cleaned on innovation and on technology with the Intel 4 debacle. AMD's cleaning their clock. That's my amateur take.
You're not. A lot of people would agree with you, as well as a number of in-house chip makers. I'm thinking Apple. I'm looking at Hasbro, also the toy maker, saying that it's going to cut about 15% of its workforce after a disappointing holiday shopping season, perhaps because all kids just use their devices and don't actually play with real toys anymore. But I am wondering whether, this is sort of the zeitgeist, as to use your word, Tom, shifting out into a broadening of some of the job cuts that we see. BuzzFeed with a similar tone. Those shares popping by about 30% because they said that they were going to replace a lot of their reporters with ChatGPT and other artificial intelligence.
Help me with this. Yeah. This is like Paul Sweeney land. We're going to do it with Bramo right now. BuzzFeed's, let's be collegial. They bought me drinks once at the Piano Bar in Davos, which was lovely. BuzzFeed has been struggling, right?
Yeah.
So what are they going to lay off journalists and do chat GP journalism?
You know, they're going to personalize certain posts for people and quizzes and some of the content that they put out using some of the artificial intelligence. The reason why I find this interesting, BuzzFeed is its own story, but there's a broader question of what ChatGPT and artificial intelligence can do. Did you see that ChatGPT just passed the bar somewhere? I mean, the bar exam. There are these
passed the medical national boards, which I tell people is the equivalent, like the CFA. They passed all 3 levels.
It just, you know, again, I mean, am I going to be replaced by ChatGPT? And I say this, you know, if it could do a better job, great. But there's this issue of, you know, what is this going to do to workforces in a new way that perhaps hasn't been established going forward?
Got anything else?
That's it. That's what I'm looking at today.
That's it? Okay, well, there we are.
I can keep going if you want me to.
Well, you know, give me one more. I mean,
Amex. Let's go to Amex.
Yeah, do
because
Amex,
I think Amex is such a different story than Visa and MasterCard. Yes. Visa and MasterCard see a slowdown in spending. Amex seeing an earnings per share forecast this year, it's going to beat expectations. And I was joking that, you know, how much of this is the Delta Lounge? But if you go and you see the lines lining up, how many people...
Never seen lines bigger. Never, never, ever.
It's an agreement, and it works for both of them. It drags in customers to American Express, and for Delta, they make billions of dollars.
American Express, their earnings. We'll continue this soiree next week with tech earnings as well. When she speaks, the fixed income world just simply stops. It is the heritage of Société Générale. They own the high ground of French math and derivative science. Subrata Rajappa joins us this morning. Subrata, help me. Let's go SocGen derivatives right now, which is calculus, which is rates of change. What's the rate of change story in the bond space this January as we see a bull equity market?
So the biggest rate of change was at the end of the year coming into this year. We haven't really seen bonds move meaningfully higher or lower from around the 3.5% level in 10-year yields. So for the most part, we seem to be kind of stuck here. You know, part of the reason is because fundamentally bonds look rich relative to fundamentals. And then you have a story where there's just a tremendous amount of demand for bonds. You look at the auction stats for this week, we saw very, very strong demand, you know, from bonds from a variety of investors. So the cash that's in the sidelines is being put to work in the bond market.
I totally agree. And we've spent a lot of time this week, folks, on issuance ideas. If there's a shortage of bonds, that's what Sir John Templeton would have said years ago. What happens to yield over the space of this year?
I don't think that there's a shortage of bonds. There's going to be a decent amount of issuance coming from, you know, corporate bond world. We are seeing a lot of issuance in treasuries. If anything, our call going into the spring timeframe was that the treasury will increase its coupon issuance sizes because deficits are continuing to rise. I mean, that of course we'll have to wait and see because of the debt ceiling. But broadly speaking, I think there's a decent amount of supply coming into bonds, not just in the U.S. and in the corporate bond world, but also in Europe in the first quarter. So there's a lot of bonds that out there to be bought, and that's why we were expecting perhaps a modestly higher yields for the market to be able to take down that additional supply. But that's not the case. It's just tremendous amount of demand, and people are willing to lop up bonds, 10-year yields around 3.5%.
Subhadra, how long will this last, this rally, this optimism that you see pervading every asset class?
You know, the data for the most part has been mixed, but on the positive side, you look at the data from yesterday that we got for the fourth quarter GDP, there's a decent amount of momentum going into the fourth quarter. You know, and you're looking at an employment picture that's still extraordinarily strong, even though you're getting a lot of news about layoffs in the tech sector. You know, look at initial jobless claims yesterday. It was very, very low. That tends to be a very good leading indicator of the jobs market. So in this sort of environment, the market is actually, in my view, underpricing the risk of hikes for this year. We're looking at perhaps 2 hikes being priced in for the first half of the year, and then a cut being priced in as early as July or September of this year, which, you know, that sort of trajectory doesn't make any sense in an environment where inflation is expected to remain high and sticky. I mean, look at what happened in Japan. I mean, we saw, you know, an outsized print, you know, relative to consensus on inflation. So there's always a possibility that, you know, we do get those sort of volatile inflation prints, and the market has to respond, and the Fed has to respond in like as well.
So what's the read-through to markets? What kind of disruption will there be if the Fed surprises to the upside, perhaps on a 50 basis point rate hike next week, but does indicate that they're going to go further than a lot of people are currently pricing in? How disruptive is it?
It will be disruptive. That's why I think that the Fed typically tends to stick with the market pricing. If the market's not fully priced, they'll find ways to communicate the fact that they're going to be delivering more than what the market's pricing in, and then the market will adjust. But broadly speaking, I think that 25 basis point rate hike and at next week's meeting makes sense, and then another 25 basis points in subsequent meetings. But I just don't see them stopping or pausing anytime soon, like the Bank of Canada suggested they will at this week's meeting.
So then how does the dollar play into this? Because that might be actually a very different story than what people are pricing in there.
Yeah, I mean, I think the dollar's come off its very lofty levels. Broadly speaking, you're looking at the dollar versus, say, the euro. You look at the ECB. The ECB is poised to hike rates for the remainder of the year. Our economists are expecting that the ECB will its deposit rates up to 3.75%. The market's underpricing that level as well. So broadly speaking, at least versus the euro, I think that the dollar could come under a little bit of pressure. The Bank of Japan as well is starting to adjust its YCC. So I think the dollar is definitely peaked. I don't see a precipitous decline, but a gradual decline as other central banks catch up on the policy front.
Subrata, thank you so much. Subrata Rajappa with us, with Society General. I was shaking my head there as she's talking about that. I have to go back to Maynard Keynes' paraphrase, when the facts change, I change. What are these central bankers going to do amid a legit trend of disinflation if that occurs?
Well, they will
They're
adjust.
going to be steadfast and just raise rates?
I wish that people on radio could see that. Charge forward kind of motion of yours.
Macron,
Yeah, exactly.
He's not going to be in Cannes. He's going to be in Paris. He's going to call up Madame Lagarde and say, what? And mon Dieu.
Well, this is the reason why the market's betting against the Fed and the ECB, but more the Fed, not the ECB, saying that you're not going to be able to do it because the facts are going to change and you just haven't realized it yet. So I think you're right. And that's what a lot of people are betting on.
What's important here, futures have deteriorated a little bit, -14 right now. What's important here, folks, is we get set for the weekend and the Fed week next week with our Fed show. It's on Wednesday, right?
Yes, correct. It's always on Wednesday. Always, yes.
I didn't know that.
Tuesdays when it begins, Wednesdays when it
It's Surveillance Correction Friday. We're just loading the boat. Bramo down in flames. Thank you, Taylor. She was in a law school library. I didn't know law school libraries were open at this ungodly hour. Anyways, Taylor, thank you for emailing in and telling us that GPT passed a law exam, like a class exam, some big class
not
exam.
the bar exam.
Not the bar exam. Taylor,
thank you
so much for correcting us.
Oh, I appreciate that.
Although in a law school library at this hour.
My favorite part about this, I actually Googled when I was slapped down for my mistake, and evidently that ChatGPT did pass a law exam, but the average was C+ versus the average of other students, which is B+.
This is important because it was the same with the doctors' boards. And it's a barely pass.
Yeah.
I don't know what that means, but do you want your kids playing with ChatGPT? I think
a lot of people are, a lot of kids are using it for their exams and using it for their essays. It's been a real issue.
God, it's un-American.
Actually, something like that.
I never use the Cliff Notes.
I was about to say.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer is dismissing calls for tax cuts. In an exclusive interview, Jeremy Hunt told Bloomberg TV, quote, "We don't have the headroom." He also pitched Britain as a hub for high-tech industries and innovation.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Meanwhile, Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the U.K. Well, it's been almost a year into an invasion that Vladimir Putin figured would be over within weeks. Now Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Bloomberg sources say House Republicans are considering a short-term extension of the federal debt ceiling until September 30th. And that would give them more time to resolve an impasse with Democrats. But it's not clear if the Democrat-controlled Senate would agree. For now, accounting maneuvers could prevent reaching the limit until July or later. And more losses for Asia's richest man. The sell-off in Gautam Adani's corporate empire accelerated on Friday, erasing more than $50 billion of market value in less than 2 sessions. The fallout from a report by Hindenburg Research has investors keeping a close eye on the $2.5 billion share sale by Adani Enterprises. The Adani Group disputes Hindenburg's allegations of corporate malpractice. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I think there's still that next hurdle for the market to get through, which is what is, I believe, more downward adjustments to at least the first half of 2023 calendar assumptions, both top line estimates as well as bottom line, which means further compression in margins.
Huge response to Liz Ann Saunders of Charles Schwab a few days ago, I should say. She was really on fire there about this odd earnings season. Lisa, to me, and Julian Emanuel at Evercore ISI will sum this up beautifully on Monday. Looking forward to that note. But I've never seen an earnings season where there's a mystery to the now and an even greater mystery out a conference call. Nobody's looking out to Q3. Nobody can get there.
I love the discussion around Intel was sort of, they're kitchen sinking it. So can we say that it's not going to get this bad and that it's actually, this is the tenor of conversation, the benefit of the doubt that a lot of people are giving companies.
The benefit of surveillance is we're always spinning forward. We're going to do that through the weekend, reading into important technology earnings next week. We're going to do that and focus on what I usually hate to focus on, Facebook. We'll do that here in a bit. But right now, Mandeep Singh, Senior Technology Analyst, Bloomberg Intelligence. And Mandeep, I've just got to take all of your heritage and your history. I don't buy the short-termism analysis of Intel. They blew it in innovation, in Intel 4 technology, in 7-nanometer, blah, blah, blah. How does Apple, AMD, and the others avoid being the next Intel?
Well, so clearly there is a share shift going on, and I think the names that you mentioned are taking share from Intel. I think the benefit of doubt that people are giving to Intel right now is PC market is really in a bad shape. You're seeing, 30% decline in volume. And if Intel's client segment revenue fell 36%, yes, there is some pricing pressure, and they're dumping as much as they can on the channel inventory. But at the end of the day, the PC market is bad and it will rebound. The problem that I see for Intel is not only they are losing share, they still haven't figured out the process node part when it comes to, just catching up with TSMC. And that is the part that worries me about, that 2 years after or 3 years after, can they recover? Because you need that process node parity.
I want you, I'm saying this with immense respect, Mandeep, for your industry expertise. From an electrical engineering standpoint or operational research, whatever, the fact is Intel blew it. That's irrefutable. How does Apple, with an A13 Bionic chip, how do they not become Intel 5 or 10 or 15 years from now?
Well, so that's where you have to keep innovating, and you need that semiconductor lead when it comes to the manufacturing side of it. Remember, Intel manufactures its own chips, and it's the largest manufacturer, and it is behind in terms of, the technology needed to manufacture the latest cutting-edge chips. So that's where Apple can go to whoever they want. They could come back to Intel if Intel catches up to TSMC. But right now, Intel is behind in terms of manufacturing, and that's why I feel the fabless chip companies have an advantage. They can go to whoever they want in terms of manufacturing, who has the lead. And that's what Intel needs to do because they are the largest chip manufacturer here in the U.S.
Mandeep, help us understand the signal from the idiosyncratic story. What's the signal here in terms of demand for certain devices, perhaps personal computers versus particular devices, Apple, or on a broader level, just consumers and cloud spending, i.e. Amazon next week?
Yeah, so look, I think PCs as a percent of overall consumer devices is going down. There is no doubt that's what you see in Intel share is PCs are not that important anymore. It's smartphones and other type of devices going forward. And that's the problem that Intel has to solve for is they have to expand their industry exposure to autos. I mean, they have mobilized a segment, but they have to do it at a much bigger scale, as well as industrials and other parts of the market where they can use their chips. PCs are shrinking, and I think that's the other thing that Intel needs to focus on, that they need to expand.
As we look forward to next week, we have seen some motley pictures with respect to cloud spending, and I'm curious what the signal is from Amazon saying that they're going to sell Bay Area offices as they look to raise money. They are cutting some of the staff. How much is tied to cloud computing, one of the main drivers of growth that we have seen underpinning big tech in the past couple of years?
I mean, the way I look at it, Lisa, the amount of data is growing around us. And to process that data, you need computing capacity. And that's where I do think even if we run into a temporary pause, which I do expect for the next couple of quarters, things will rebound. You will need more cloud capacity. You will need more semiconductors and chips, but you won't need CPUs. And that's the other big difference. The world is going to custom chips. That's what Apple has shown us, and you're going to need more of that.
Mandeep, I got to get into next week. And the fact is, I'm stunned, folks. I just did this math on the Bloomberg, and I never would have guessed this. Talk about a face plant from Facebook. The Intel drawdown from 3 or 4 years ago is a negative 54%. Meta, it's like can't.
Are you kidding?
Meta?
It's not the cheese. It's not like you put it on
Velveeta?
bread. Yeah, like Meta. Put some Meta on your tomatoes and cucumbers.
Intel's down 54%, and Velveeta's down 60%. When is Zuckerberg going to wake up and realize he's done an Intel? What are you going to listen for in Meta earnings next week? With a stock with a drawdown of 60%.
I mean, although it has rebounded 50% from its lows in October. So I guess you can look at the time series in different ways, but you're right. It is down 60% from its highs. And look, at the end of the day, with social media companies, it's about engagement, engagement, and engagement. And the fact that they're losing engagement on the Core Blue app, Instagram also seems to be losing engagement. And then you have an ad pricing headwind for pretty much the entire digital ad vendors. That is where the focus will be on engagement. If they can turn that around, catch up to TikTok, really get off, the issues they have had with Apple's privacy changes, I think those are the key points for the near term. And then beyond that, the VR strategy will come into play. How much losses can they afford, for the next 2 or 3 years when it comes to their Reality Labs ambition?
Well, next week, we are so advantaged, and we hope all of you on Bloomberg Radio and Television are advantaged with Mandeep Singh and Anurag Rana from Bloomberg Intelligence on the tech space. And I do note Mark Gurman's industry-leading reporting for Bloomberg News on Apple as well. PR from Kraft Foods just emailed and said, we are the product of Velveeta.
Not Meta. Put some Meta on here with that.
Thank you, Kraft, for that announcement.
Thanks for that cookie
Not
lesson.
that I
I
would have
appreciate
any
it.
familiarity
Exactly.
with Velveeta. Did you have Velveeta cheese in your refrigerator as a child?
No, I did not. No. But I did have Kraft macaroni and cheese after school with my brother. We'd pour 2 boxes in and we'd take 2 spoons and we would eat it before dinner, and that would be a snack.
That would be a snack.
Yeah, exactly. That's,
Kraft Foods.
yes. Look, I think with all the earnings that are coming up next week, this to me is going to be the true test, the sort of question of what narrative we can actually sell heading into the remainder of the year. In some ways, tech is going to set that narrative because tech has been the main driver of some of the gains that we keep seeing. And if that fades, what's going to pick up that slack, at least in the near term?
Dan Ives, who joined us this week, and I get it. Ives is like a piñata because, he's the uber bull on technology and he's hugely visible within the financial media. But the reason is he's deserved to do that because he's pounded out Excel spreadsheets. And his basic take this morning into next week, look at what they're saying. Like Microsoft, numbers, up they go. They crater over the worry. And then the stock, just in the last couple days, has clawed back to some sense of optimism because of their scale, their level. Yeah, they're nicely above where they were before our earnings. I'm going to call it 242 down to 232, down $10, and up they go, closing 248. That's the Dan Ives approach that we're seeing.
And that's the reason why some people are saying that a number of these tech companies are going to do the kitchen sink. They're going to lay people off, people who they perhaps don't even need, but it's a good excuse to cull the herd. And we got one viewer writing in, unfortunately, Intel seems to have multiple kitchens and many kitchen sinks to go at. So,
that's just failed management. When everybody starts talking about kitchen sink, all my radar goes up. That's all there is. They're free cash flow negative.
How much bad news can you put out there is sort of the question. We also got a correction, another surveillance correction, because we're doing really well today.
Where's Farrell?
We're just crushing it. He's going to come save us. That Velveeta doesn't need to be in the refrigerator, and that's why you had none in your refrigerator, because it's stabilized and it's probably not really related to anything that other people would identify as food.
I have a memory of Jif, like peanut butter.
Oh, I had Jif.
Peanut butter and Velveeta. Was a way
you had an amazing childhood, Tom.
Get to dinner. It was a scarred childhood, to say the least. Coming up, Farrell will save us. John Farrell and Andrew Balls, must watch, must listen. Good morning.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think there is going to be some significant aspects of pent-up demand that are going to start showing.
This is about being active and taking advantage of opportunities again after last year.
The bigger question is, are we able to maintain that momentum as we turn the calendar page? And most of the data suggests that we do not.
The Fed will deliver a slowdown in the economy. It will deliver a loosening in the labour market, but it's how quickly it can do that and whether or not it wants to ease back this year.
I don't think we're out of the woods yet, but I think we're going through that bottoming process.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was the earnings. It is the U.S. economic data. Good morning. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene here in New York, Jonathan Farrow in London. I'm Lisa Abramowitz. 30 minutes away from a complete shift in narrative, potentially with core PCE income and spending.
Thank you so much for bringing this up. We have been amiss here, buried in earnings and looking at the collapse of Intel and such. We have a huge earning dump here coming at 8:30 and then on to 10 o'clock. And John Farrow, Lisa, has been ahead of me on this. I'm not a fan of confidence statistics. I just, I'm posh about it. I'm like,
because they didn't call
I don't
you.
want to do it.
How do you feel about Jiffy?
Exactly. But I'm looking at Michigan sentiment and Michigan 5 and 10 year forward inflation expectations, and that's big data this morning.
We've been remarkably Fed-free because we've been focused on the earnings, on the actual tangible day-to-day that the companies that have been reporting reflect, and yet this conversation will shift. It is the quiet period ahead of next Wednesday.
Thank God for that.
But the conversation may shift if you get core PCE that comes in above expectations. That is the key metric that this Federal Reserve does look at.
Well, it's going to be the mystery, and to me the mystery is economic growth. We're going to do that with Andrew Balls here in a moment with John in London. But there's a basic idea of central banks that have a plan, and will they be derailed by some form of lesser animal spirit, nominal GDP, and some form of disinflation. On a Friday morning, I got an 88.46 Brent crude, up $1, up 1.1%, getting near $90 a barrel. I don't know how you get disinflation with $90 Brent crude.
This is the tension right now. Don't fight the Fed. The mantra for a decade all of a sudden is fight the Fed because they're wrong, because they're not looking at the data that we're looking at, and that's what you're seeing with an easing in financial conditions. Moderately tighter, I guess, on the margins, financial conditions, at least for now, if you look at the equities. And they are just marginally lower, but who knows what happens come by 4 p.m. today, because it seems like everything just bleeds higher.
Just lifts at 10 a.m.?
Exactly. 40 basis points lower, 40.59 on the S&P. Honestly, the dollar strength that you start seeing come back, how much and how sustainable is it? Are we seeing the end of the dollar losses? Euro 108.60, still kind of stasis there, down about 0.3%. And that 10-year yield just marginally up, but it's been around 3.5%, pretty stably, pretty consistently throughout the past couple of weeks.
I heard that from Subrata Rajappa at Societe Generale as well. There's just a churn within the bond market. And I guess at the end of the day, I'm looking at the Bloomberg Financial Conditions Index, which did move this week and moved out to new accommodation away from where Chairman Powell wants it to be.
Let's get, you mentioned Andrew Balls, the head of fixed income for globally for PIMCO, over with Jonathan Farrow. John, I do wonder, though, how much people are going to start talking a little bit more about the don't fight the Fed, fight the Fed, because the Fed is wrong.
Well, let's talk about that right now. Andrew Balls at PIMCO alongside me. Lisa, thank you for that. Andrew, welcome to the program. You put out an outlook recently with Tiffany Wilding. I think it was strained markets, strong bonds. We talk about a strained economy as well. You've got recession, I believe, in the US and in Europe as well. That Europe story here is starting to change. Why are you sticking with that call?
So the baseline is we'll have a recession in Europe, the US, the UK, number of countries now. The energy price situation is clearly a big positive in terms of the European outlook. And when you're thinking about the shallow recession versus a deep recession, then I think that there's definitely an improvement in the outlook. But given the financial conditions tightening that we have seen, more to come from the ECB. The baseline is for shallow recession in Europe, which is broadly what we think financial markets are pricing in as well.
What's the baseline for the United States now? You've got the Federal Reserve saying we're going to hold, and you've got the markets saying cut, cut, cut. Where are you on that?
So I think the Fed will go 2 more times and hold in March and wait and see. Powell has created the space for this, talking about the lags and so on. From our point of view, it's likely that the Fed will then be on hold for some time. When you think about markets, markets pricing in all sorts of scenarios. There's scenarios where the Fed will have to cut deeply if the recession is much deeper. But the most likely outcome, I think, is the Fed on hold. And we're still not out of the woods on inflation. A lot needs to go right on the inflation front. And so the risk, which markets were very focused on last year, has receded in terms of the Fed having to be a lot more unfriendly. But in terms of our positioning, we want to still pay a lot of attention to a scenario where inflation is stubbornly high, and you're going to have another period of Fed rate hikes, which clearly would be quite difficult in terms of risk assets, asset markets more generally.
Can we build on that a little bit and talk about the volatility in the bond market? The difficulty of last year was pricing the risk-free asset, the so-called risk-free asset, which makes it almost impossible to price the risk asset. This year, I think people were hoping for stability in Fed funds to really understand how to price everything else. If we have this gap right now between market expectations and what the Fed's trying to signal, can we resolve that gap? Can those two reconcile without getting another burst of bond volatility?
So I think so. I think a baseline of lower volatility compared with last year in fixed income markets is a very good one. I mean, it's a low bar because there was such a lot of volatility last year. And I think if over time markets price out those Fed rate cuts priced in for the second half of this year, I don't think that has to be very dramatic as you get more confidence in the shape of the recession and recovery this year. That seems perfectly plausible. The thing I think would be destabilizing, volatility inducing, would be if it looks like inflation is going to get stuck, core inflation, well above 2%, and you have to think about further rate hiking, the Fed causing more of a slowdown. So guard against that. The market pricing out, the rate rate cuts in the second half of this year. I think that can happen in a lower volatility environment, and a lot of the strategies we'll do in our portfolios will A, be positioning for lower volatility in fixed income, but B, continuing to guard against the tail of worse macro outcomes or worse inflation outcomes.
So with that in mind, let's talk about the investment process at PIMCO. Just take us inside the investment committee, if you can. At the center of it, at the core, you've got Fed funds, and then the further out you go, you've got all these circles. Can you just go through what these circles are and how far away you want to move away from the core of fixed income?
Yeah, so we talked about this in our outlook. It's a framework we've used for 10 years longer. At the center of global financial markets, you have the Fed and short and intermediate interest rates in the US, in the G10, and this is important. The stability there is important in terms of the causal effects on risk assets. So as you move out of our concentric circles into credit, into emerging markets, into equities. We think a prerequisite in asset allocation portfolios, say, of wanting to add more equity type risk is wanting to see that stability in global fixed income. And hopefully the restoration of more normal correlation between fixed income and risk assets and equity markets. So last year, you destabilized the center of that, the global asset markets, the Fed funds, rate expectations, big shift in terms of the Fed or Treasury yields in the US, very destabilizing for global equities. This year, we have the prospect of lower fixed income volatility and really good yields in terms of core fixed income, which is very important. So in our investment decision making, we're going to be emphasizing core fixed income, good yields that you can get there, and then be careful about the risk that you add. High quality investment grade credit makes sense, but we don't need to have lower quality credit, high yield. We can get good enough returns, we think, in the center of this distribution, and continue to respect the fact that the recession risk is two ways. It could be better than our baseline, but it could be a lot worse as well.
This is another way of saying I don't like emerging markets right now. Can you build on that a little bit?
So I think we are scaling into emerging markets. We have emerging market positions, select FX positions, select local or dollar-based EM. So I think that it's going to depend on your asset allocation. But for us, I think at this stage, core fixed income, very good yields, about 5% for kind of core bond funds looks very attractive. As we get more confidence in terms of the shape of the recovery and or the path for the Fed, you can scale into EM over time. And EM was earlier hiking. They were earlier in the cycle. The yields are quite attractive. So I think there's good opportunities there.
I've got one final question for you. You're a bond guy, so naturally you're worried about something. Tom Leach and I have talked about this over the last couple of weeks. This is the third year of pandemic economics, and every single year we seem to have got it wrong, big time. Is there one thing that you're worried about right now that you think people might be getting wrong as we go into year 3 of this?
So the thing I am worried about is the possibility of higher inflation. So to relate it to the pandemic, longer time for healing in terms of all the disruptions we've had, and stubbornly high inflation that takes more from central banks to cure. It's not the baseline, but I think that is a big risk. And I think if you look at the last couple of years, no one's won any prizes for their inflation forecast during this period. And the baseline is the baseline, but you need to think very carefully about these risk cases. And the one which would worry me at night is stubbornly high inflation settling well above 2, 3 or 4% type core inflation, and if that happens, that's going to be very interesting in terms of financial markets and volatility.
Yeah, Andrew, always a clinic. Good to see you in person. Andrew Ball's there at PIMCO. TK, always a worry if you're a bond investor. There's one for you for the year ahead.
John Farrell, thank you so much. Appreciate that. Futures negative 14. Please stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. There won't be a tax cut anytime soon in the UK. Chancellor of the Exchequer, Jeremy Hunt, spoke to Bloomberg TV today in an exclusive interview.
We don't have the headroom for major tax cuts, but if I was going to prioritize where I would like to see tax cuts, it would be business tax cuts. What businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households, it stops them spending, and it puts off businesses from investing.
Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the U.K. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. Bloomberg reports that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. And Chevron posted a record profit for a full year thanks to surging commodity prices and domestic oil production. That generated unprecedented cash flow that will help pay for a mammoth $75 billion share buyback program. Earnings more than doubled to $36.5 billion from a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is not going to be an easy one for the Fed. I mean, currently the market is pricing 4.9%, let's call it 5% terminal rate. I think we could reprice a bit higher. The Fed has become a far maturing theme. We're getting close to the peak. And now the driving seat is global growth expectations. And this has been, reignited by the Chinese reopening. And this is what is driving the markets.
Vasilya Giannakis on Citigroup looking at the international ramifications of speculation and hedging on foreign exchange in this earnings season. Lisa Bramowitz and I are looking at the foreign exchange effect for multinationals. And I'm going to say so far it's like a four-ish.
Yeah.
It's like in-betweeny.
Well, it's in-betweeny because you have the hit that people took last year and then the expected tailwind that they're going to get this year from a weaker dollar. So people are saying it'll be offset and it's a wash. So, people can kind of look past an FX effect that in some cases were hundreds of millions of dollars.
It can be like real money, but the rule of thumb here, folks, 2-3% is like normal. And last year was ugly, what, 5?
Yeah.
We saw some 7%. And now you got a foreign exchange effect of 4%. So it's in between is where we are right now. This is a joy. We did this on short notice. We've had so many surveillance corrections today that somebody said, save the show. And we do that with Joseph Feldman. Joe Feldman is with Dana Telsey at Telsey Advisory Group. And what I love about Joe Feldman is he doesn't write 15-page notes. He writes like 4-page specials and cuts to the chase. We're going to devote this section to Amazon, which everyone on radio and TV uses Joe Feldman. Have they lost their step? I mean, when you look at Amazon, Joe Feldman, do you say to yourself, the boxes in our houses, in our stores, the ubiquity of it, that it's threatened?
I would not say it's threatened. However, we're maybe seeing some normalization where, they're not immune to the consumer slowdown that we've seen in the past couple of months and the concerns that we have about consumer going forward. You add on to the fact that their AWS business, which is their cloud business, has been a little bit slower as well because cloud computing's been slower. They were a huge beneficiary during the pandemic with people shopping online and buying and having those boxes shipped to their homes. But since then, they've had to readjust.
Joe, this is important, and it's what's going to be unspoken on the conference call, which you're on. They shake in trepidation out in Seattle when they go, Mr. Feldman next. Joe, real simple. The cloud guy, Jassy, has come in to pick up the pieces. And the great unspoken is about the guy before him. Did Mr. Bezos screw this up? Or did Mr. Bezos take his eye off of it because he was down in Hollywood figuring out the next space flight?
Well, I do think that the management got a little ahead of themselves during the pandemic, and they were trying to, keep up with the demand. And as a result, they built out their capacity much quicker. And there was such an acceleration in demand, the capacity doubled. Or was increased by 50%. Sorry, not doubled, 50%. And that was, arguably too much. It now has ebbed a little bit, and they've had to readjust and bring that back down. So that's where you could say management, I wouldn't say took their eye off the ball. I think they were doing what was right for the consumer, but then they got kind of stuck and have had to backtrack a little bit. So there was some erosion in the profitability at the same time that sales were slowing a little bit.
Joe, we know the story, and this has been really the question. How much of it's been priced in, given that these shares lost 50% of their value last year?
Well, that's a great point. I do think a lot of this is actually priced in. Now, I know, earlier this week when we did our preview, we did lower our price target to $125, but that's still, 25, 30% upside from where we are today. So we still very much like Amazon, and we actually think this could be a very nice recovery year for them in terms of better profitability, especially as the year progresses and they start to lap some of the challenges that they faced in 2022. So from a stock perspective, it actually feels like a lot's priced in, and I think there's some optimism what 2023 might prove out to be.
We've been talking all morning about the changing workforce, the potential for retirees to get back to work, as some people in the UK are calling for, and this question of artificial intelligence and how it affects some of the biggest employers out there. I look to Amazon and what they're doing there. How much is that part of that recovery story in terms of automating parts of their warehouses and really leaning on that to fuel their growth?
Yeah, I think Amazon has been on the forefront of leveraging technology to fulfill customer demand. It's certainly among retailers. And, they're one of the leaders. They were very early, leveraging robotics technology, and I think that's going to continue to help them be more efficient in the future.
Joe, a two-part question, but linked together, and this goes back to the pre-pandemic analysis. Okay, Amazon stumbled, but do they get an EBITDA margin back, which I'm going to estimate, let's call it 14, 15 cents on the dollar? And with that, do they flip to free cash flow that can exceed the wonderful year of 2019? Is this the year that happens?
Well, I think this could be a nice recovery year for them. And we do think that you're going to see, as you said, that, kind of 14, 15% type EBITDA margin this year, and could see some really healthy recovery. I do think this will be a decent year for Amazon. I think they can operate more efficiently. I think that, they're controlling their costs, they're watching their labor, they're leveraging the technology, and if they can, maintain some solid level of consumer demand, which we would expect. I mean, we're still forecasting sales to be up, 10 or so percent, 11% this year. They should be okay. I think it'll be a good year for Amazon.
How much is that belief, that optimism, Joe, hinging on a macro call of greater consumer spending versus an idiosyncratic story of a company that has adjusted and adapted?
Well, it's a great point, because I do think that some of this is related to the consumer holding up somewhat. We are forecasting, some slowdown, certainly in the first half, maybe middle of the year. We're hopeful second half starts to recover a little bit towards the holidays again. But, I do think that Amazon's taking market share and continues to take market share across many different categories. They got very aggressive with their, the prescription pharmacy plan that they offered the other day to Prime members. And, that's just like one small element. They're getting deeper into grocery. They're doing so many things that can capture market share to help offset some of the slowness in the broader consumer.
They're getting deeper into grocery. Do you suggest they will expand whole paycheck from sea to shining sea?
Well, they really like their Amazon Fresh format, too. So I think that we're going to see more of those Amazon Fresh stores. There's already one in New Jersey over in Paramus, and I think that we'll see more in the Northeast and across the country.
What's Amazon Fresh, Joe? Inform me.
It's essentially their version of a grocery store. It's like a traditional grocery store, but it has the bells and whistles of the technology where you can go in, you scan your phone or even your palm, and it attaches that to your credit card, and you can shop the store and walk out without even seeing a cashier.
Are the
So the technology makes it easy.
Are the avocados cheaper there than at Whole Foods?
Well, yes, and Amazon they're positioning the fresh concept as a more moderately priced grocery store relative to Whole Foods.
Joe, everything is more moderately priced than...
I love that you're doing your shopping with Joe Feldman. You're doing literally your,
But you and I are so behind on this. I mean, there's so much technology in food now, and Amazon's trying to do it. I've never been in an Amazon Fresh, but like he says, you just walk in with your phone, and
it tracks you.
It tracks you or whatever.
Yeah, so you can just walk in and walk out. I have not, no, but I've done other technologically induced food experiences.
Remember it's a Velveeta. remember the magic of Fairway on the Upper West Side, and that was just so original.
But it wasn't because of technology. It was also some of the goods and what specifically you could buy there, and the sort of specialties that you could purchase. This just crossed, and I do want to bring this up, that there are more people now falling behind on car payments than at the peak in 2009.
Interesting.
So we're talking about the resilience of the U.S. consumer, and yet you see this issue after the prices of cars just exploded during the pandemic.
I mean, the old $250 a month is now what, $400 a month?
There are people who are paying more than $1,000 a month, which is basically like another mortgage, depending on what they finance.
I paid off the Nash Rambler in 1968.
And when was the next time you bought a car?
No, I still have it. It's great. I don't take it out much in the winter, sometimes with chains, but no, I don't.
Chains. So if you hear that clunk, clunk, clunk down Fifth Avenue, that's Tom Keene.
This is Bloomberg. Good morning.
typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Savannah's from New York and from London. John Farrow in London. Look for the 9 o'clock soiree with Mr. Farrow here. He'll do that here in about 30 minutes. We have been remiss today. Lisa, you and I have failed in earnings season. We haven't played up the economic data.
I was about to say, which aspect?
Yeah, there's too many aspects, but yeah. we really have underplayed this important economic data.
Especially because it's some of the key data that the Federal Reserve looks at ahead of their meeting next week. But really, the core PCE is going to be interesting to me, and income and spending, and we're getting those figures right now.
Income data coming in right now, and that means Michael McKee will dissect like he did a buoyant GDP statistic earlier this week.
Well, buoyant on the headline, not so good down below, but that's okay. We'll take it. Here's the numbers you want to see. The PCE deflator up 0.1%. That matches last month. That is a little bit ahead of the expectation for a flat reading. On a year-over-year basis, pushes us down to 5% from 5.5, and the core rate is up 0.3, a tenth more than last month, but that matches expectations, pushes us down to 4.4% for the year-over-year. That's down from 4.7%. So obviously the Fed is getting some progress in its inflation fight. Personal income's up 0.2% on the month, and personal spending down 0.2. Those both match estimates, so bravo to the economists who did the forecasting. The incomes number down from a revised 0.3 last month. Spending is down from a revised -0.1. Interesting note here, guys, that and this didn't show up as much in GDP because that comes out as a quarterly number. October personal consumption was up, but November and December down. So the sequential move is to a slowing consumer at this point.
I want you to go to the basics here. I'm always looking as an amateur at year-over-year PCE deflator, and as you mentioned, 5.5 down to 5. But you've been lecturing me in the last 90 days, month-over-month matters. Into this new year, is month-over-month more important to you and the Fed than year-over-year?
Personally, I don't care. But to the Fed, no, seriously, to the Fed, it matters because what they're trying to do is eliminate the base effects from last year, and they want to see what the sequential progress is. If you were going to do a comparison to last year, you might want to do something compared to, say, March of last year when they started raising interest rates. So the year-over-year is what gets the headlines and what kind of the consumer looks at, but the Fed's looking at the sequential change because they want to make sure that they're getting a regular decline in the numbers. Let me just give you this savings rate. It went up to 3.4% from 2.9%. So that was a concern out there that people were spending down all of their leftover stimmy money, and now it looks like they kept some aside in the month of December. Wages and salaries, though, they sort of decelerate 0.3. November was 0.5. Now revised down to 0.3. So a little bit of slowing on the wage and salary front, which is also going to be good news for the Fed.
Well, basically, this is not really that newsy for the markets. They're basically stasis across the board as people priced in most of this. This was pretty much bang in line with expectations. The one area, Mike, that I want to focus in on, though, real personal spending. When you strip away the inflationary impulse behind it, it dropped more than expected. Are we seeing a consumer that is being warned duly by what's going on and pulling back ahead of the storm?
Well, I think that you're seeing basically that. Now, is it because they accelerated all their spending into October and September was also large as well because they felt they needed to get their Christmas shopping out of the way early? Or is it because people are really pulling back? This is something of a seasonal thing. The last year we saw basically the same dynamic. So are we seeing a change in consumer spending patterns? But you're right, real personal spending lower. Now you're taking inflation out of that. Real personal spending up 0.3 compared to a 0.2 decline last month. So, well, you know, it does show a slowdown. Now let's see what happens in January when Tom goes to Amazon Fresh and shops.
This will be a test effort. Michael McKee, thank you so much. Getting ready for the Fed meeting next week. Red and green on the screen. A nice recovery here off the report just minutes ago, and the yield space up 3 basis points, and the 10-year yield 3.53%. We're watching oil nearing $90 Brent crude. This is a joy because it is the heritage of what Neil Sauce did at Credit Suisse. He is Ray Ferris, their chief economist, joining us, and he and I are on the same page that everybody inflation adjusts. And Mr. Harris and I go, maybe not. Nominal GDP matters. What is the global Credit Suisse outlook on the dynamic of nominal GDP with disinflation in place?
Well, that's absolutely right. The key thing, I think, for corporate profitability, the outlook for earnings, is really nominal money. And nominal GDP growth, after a boom in late 2021, early 2022, is now slowing a lot. That's the disinflation process. So what that means is that at the top line, revenue growth is going to come down. We're already seeing that. There's a good link between nominal GDP growth swings and margins. Margins are going to come down, and we're seeing that. And although we think that there will be consumption growth in 2023, that consumption growth, especially in the goods sector, is going to be very, very weak. So slowing revenues, squeezed margins, and not a whole lot of volume growth.
Sitting in that chair this week have been a number of people modeling out some form of reaction function, trajectory, whatever you want to call it, down to a level of disinflation that I think would shock our listeners, shock our viewers. 4%, 3%, some even modeling under 3% is an inflation picture for the United States. Are central bankers prepared to have their minds change when the facts change?
Oh, the Fed's already moving. I mean, you can see that the Fed, that this shift from 50s to 25s, and I suppose recently the comments out of Lael Brainerd, suggests that the Fed is beginning to kind of adjust to the fact that the economy's weakened and that it views itself as being in restrictive territory, and at some point it's going to pause. That's the right thing to do. What they're not ready to do because of the level of inflation, and Mike just identified this, I think, nicely. There's the month-on-month stuff, which looks pretty good, but then there's the fact that what the public cares about is the year-on-year numbers, and those things are still high. So the Fed is going to have something of an asymmetric bias toward hawkishness until it can get those year-on-year numbers down to safe territory. And I think that's below 3%.
So you mentioned Lael Brainerd. Let's go there. Some people, including Citigroup's Andrew Hollenhorst, saying that if she does take the job with the White House, this could actually increase the hawkish tilt of the Federal Reserve, that she was actually more of a moderating voice, saying maybe the risks are a little bit more balanced. Do you agree?
Well, maybe. Or, you know, I think there's probably some extent to which she's also been a trial balloon, you know, and this Fed seems to me in their communication strategy to have been much more coordinated and sort of game planned than, say, Feds of 3, 4, 5 years ago, when it was really just a talking shop in public.
When it comes to the actual economic data, how much are people overlooking the Chinese coming online? The fact that China ended zero COVID and we're going to get some sort of boost with the consumer spending that perhaps could also juice demand for commodities and for other goods.
Exactly. We just wrote about this, and we think that at a global level, the impact this year is going to be pretty modest, at about 0.2% of global GDP. Most of that is going to be focused outside of China. Most of that's going to be focused in Asia. Countries like Thailand and Singapore, the Philippines are going to benefit as the Chinese begin to travel abroad again. In Europe, maybe a small boost, 0.1 to 0.2%. The United States, very small. The key thing is going to be the impact on energy prices. And this is one of the reasons why the Fed, at this stage, even with a succession of pretty good month-on-months, can't take for granted victory. If, for whatever reason, the Chinese manage to drive up oil prices well above $100 a barrel, well, headline inflation is going to return to being something of a problem.
Yeah, but you're underplaying your knowledge base here. You own the Pacific Rim for Credit Suisse for years and years and years. Nobody's hit Raffles Bar like you. The bottom line is you're suggesting Brent crude with Pacific Rim oil demand coming back. Are you suggesting it could pop above 100 and find new levels up at 110, 120?
That's not our forecast set. Our forecast set is, kind of around 90, about where we are right now. What I'm saying is that it's been very, very difficult to predict.
Yes.
We have to recognize that the energy markets are very tight. We're not getting as much of a response out of the United States in the shale patch. OPEC is sort of back in control. So, if I were the Fed, I'm sitting there, is there a chance that despite all my forecasting, that oil surprises to the top side and that really damages my inflation outlook? Yeah, there's a chance. So I can't take that risk.
Again, with your history of the Pacific Rim, do you just model out yield curve control goes away and we get yen stronger back to where we knew it?
I think that's right, but only after the new governor comes in.
You're going to wait till the spring.
So we need to get the new governor in April, and then we need a policy review, and then probably in June we'll take away yield curve control. But note that the BOJ has a new facility that allows it to lend to banks against JGBs at sub-market yields. So it's created a facility that will allow it to manage the process of 10-year JGB.
To me, it's almost like It's almost like sterilized currency moves. They've set up a sidecar move.
Correct.
Almost like a sterilized yield curve control.
So it's the one place that wants inflation. So externally, the IMF may be excited about Japanese inflation. Well, so were the Japanese, except in the opposite direction. They want it.
Yeah. Ray Ferris, thank you so much with Credit Suisse and some serious Pacific Rim cred there as well. Red and green on the screen. Lisa, bonds lift here. What do we see? We got another tranche of economic data coming out here at 10 o'clock.
Yeah, the University of Michigan Sentiment Survey, which perhaps will give some insight into why people are saving more and spending less. That is the theme that I can see, that people are kind of girding for a winter that hasn't come yet.
I was unbriefed on this. Pending home sales at 10 o'clock, to me, is not a small issue. Liz Ann Saunders was heated that she's watching home economics, if you will.
It's the first
more than anything in America.
And we're not talking different cooking classes, but this question of whether we've seen the bulk of the Fed moves in the most sensitive area of the economy, and that is the housing market.
And the housing market, the labor market as well. Goodyear Tire, far, far off the radar. Goodyear Tire to cut 5% of global salaried staff. This is special. Richard Haas out with a new book. Ambassador Haas will join us here in a moment. Stay with us. Red and green on the screen. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer is dismissing calls for tax cuts. In an exclusive interview, Jeremy Hunt told Bloomberg TV, quote, "We don't have the headroom." He also pitched Britain as a hub for high-tech industries and innovation.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Meanwhile, Hunt also pushed back up against U.S. and European plans to subsidize green industry, which threaten to divert investment from the UK. It's been almost a year into the invasion that Vladimir Putin figured would be over within weeks. Now Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Customers using American Express spent a record amount last quarter, and the credit card giant predicts that revenue and profit for this year will surge well above estimates. Amex has been tweaking rewards on many of its cards, and that has helped it add millions of new cardholders last year. And Americans are falling behind on car payments at a higher rate than during the financial crisis in 2009. According to Fitch Ratings, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose almost 5.7% in December. And that's more than twice the record low set in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
If Republicans want to work together on real solutions and continue to grow manufacturing jobs, build the strongest economy in the world, and make sure Americans are paid a fair wage, I'm ready. But I will not let anyone use the full faith and credit of the United States as a bargaining chip. The United States of America, we pay our debts. It took 200 years to accumulate that debt.
The President of the United States there driving forward the story of maybe late summer or autumn, the debt ceiling debate. We tried to avoid it this week. We failed. It is there. It is ever and ongoing, and will be a political football into the Sunday talk shows as well. It just won't go away, will it?
No, and even if they kick it down to September 30th, it's not going away.
Lisa Browitz and Tom Keene here. John Farrell getting ready in London to move the story forward here on economics, finance, investment, red and green on the screen. And we are going to stop right now. We can do this with Richard Haas. It was my book of the summer, book of the year. I can't remember right now, but his book on how to figure out the new Western Civilization 101. The world was so important, and he comes back with a jewel. It is the Bill of Obligations, but far more, Lisa. This goes back, and this is corny, but unbelievably tangible right now. A scout is trustworthy, loyal, helpful, friendly, courteous, kind, obedient, cheerful. I memorized this once. Thrifty, brave, clean, and reverent. Richard Haas takes us back to another time and primarily screams for some civility within our fractured American society. Congratulations on the 10 Habits of Good Citizens.
Thank you, sir. It's so interesting you quote the Scouts Oath. The Scouts are one of the very few organizations in America, Girl Scouts and Boy Scouts, that actually teach civics. They actually are invested in the fabric of this society.
It changed me. It was the whole Eagle Scout thing a long time ago and all that. How did we get here? How did our society get to where you had to write a piercing 140, 150 pages on America, get your act together?
A couple of reasons. One is we don't teach our story. The fact that we don't teach civics in many schools, if we do teach it, it's inadequate. You can graduate from virtually any college or university now, Tom, and if you navigate your course distribution right, you'll never study physics. Yep. Civics, you'll want to understand the basics.
Or physics for that.
Or physics for that. Sorry about that. So there's that. I think media and social media has contributed to it. Increasingly, people go into their own ecosystem or ecosystem, whichever you want to call it. They go for things to confirm their biases. Social media is much more about social than news, but this is increasingly where people get not their information, but their misinformation. I think people have also become more skeptical of government. You know, things you talk about on this show, the failure to manage the economy well, things like the wars in Iraq and Afghanistan. It's created a sense of populism in this country for any number of reasons. There's been backsliding here. And by the way, it's not unique to here. We see it in Brazil. We see it in Mexico. We see it in parts of Europe. I think democracies are under pressure. We just never thought it would happen here. We're the world's oldest democracy. We're the case.
Jeff Sachs screamed about this out of Columbia 10 years ago, even 12, 15 years ago, talking about the fractured American education system. What's the best practice model out there worldwide that we can learn from to begin at the margin to improve our social education process?
Well, we have some good examples. Yeah, we still have the best higher education in the country, in the world. I would say the problem is, again, we don't require certain things. We offer them.
You call this the Oberlin model?
I would not put that at the pinnacle. But no, people line up around the world to go to American universities. The problem is universities let people off their campus without requiring them to do certain things. Finland, for example, has just recently started an experiment for high school kids. You want to go through elementary school and high school, you have to become what's called literate in information. They teach you how to navigate this world of information, misinformation. What's a fact? What's something else? What's an opinion? They just, by the way, passed that. Interesting enough, one state in the 50 states has that rule, that law. New Jersey just passed it the other week. Every New Jersey high school graduate is going to have experienced information literacy.
Well, you wrote this book. There is more than one page, but you handed us this card, which had the ethos that you are trying to espouse. And how much is this really an indictment of the moment that we're in terms of people's attention span and ability to focus? In other words, do you see any progress in the places that you're basically saying for civics that could actually salvage what you're hoping for?
I see the potential for progress. Almost every group I speak to, and in some ways the reason I wrote this book, people know there's something wrong. Americans get it. Look at the polls. They've lost confidence in the future. People know there's something wrong. There's a lot of interest in teaching civics. People know that something's going seriously wrong in Washington. They're alienated from the government. So I think the potential for reform is there. The question is whether we can get sufficient involvement. The fact in the recent midterm elections, given all the stakes, less than half the eligible voters voted. That's something wrong. We've got to get people more informed and more involved.
How does this really dovetail to the U.S.'s position internationally as someone who has been in the diplomatic world for your entire career, and considering the fact that the rest of the world sees the dysfunction in Washington and reacts to it?
100% right. The Chinese like nothing more than to show pictures of things like January 6th on their television and go, see? The quote-unquote democracy is the same as anarchy. So the authoritarians love it. Makes it very hard for us to say, emulate us when we don't look very good. More important in some ways, it makes it very hard for our allies to trust us. They see the discontinuities that have come into American politics. They no longer have the assumptions of reliability. And I think our foes, for the same reason, are much more willing to challenge us because they're not sure we're going to be there.
On radio and television, Richard Haas with us as we celebrate his new book, The Bill of Obligations. Can't say enough about it, 150 pages here. And now we're going to migrate to Richard Haas, Oscar analyst, expert on movies. There I was watching, I call it The Banshees, the Irish movie that's up now and I thought of you. They're looking across the harbor at the war going on in Ireland. You lived it. Did you see that movie? And what did it bring back about the Irish tension that is and will always still be there?
I did not see it.
You have to see it. You're
I
in
know,
it.
but I've been kind of busy, Tom. But two things. One is that a lot of those issues, not so much the Ireland English thing, but the problems in Northern Ireland, Brexit. One of the many consequences of Brexit, it has reintroduced friction into Northern Ireland. Northern Ireland went through 3 terrible decades of the Troubles. I don't think now it's inconceivable that we could see some sort of a reintroduction. Clearly, we're seeing greater friction there. And by the way, given what we're talking about this morning, it's a warning for this country. I'm not worried about a new civil war. I am worried about an American version of the Troubles, where we have politically inspired violence around the country. It is not inconceivable. No one should think that January 6th is a one-off. Look, you got a big business audience in this show. Businesses, besides thinking about ESG and DE, politically inspired violence around the country, it is not inconceivable. No one should think that January 6th is a one-off. Look, you got a big business audience in this show. Businesses, besides thinking about ESG and DEI, businesses ought to be thinking, what can they do to promote American democracy? They have an enormous stake in the rule of law.
Just real quick here, before we let you go, you were talking about social media, the involvement there. There's a push to ban TikTok, in part because of the Chinese ownership. Do you think that restricting social media is the answer?
It's part of the answer where we have to restrict, we have to regulate it. What are the responsibilities of the carriers? Are they publishers? Are they simply pipelines? I think that. But more important is probably to make the people who go to social media more discerning. How do we make them understand the limits of social media? Again, I want citizens to be critical consumers of information. Ronald Reagan called for patriotism, but first he called for informed patriotism. What we need to do is make sure we are critical consumers of this information soup that we're all living in.
Richard Haas, thank you so much and congratulations. And I don't like the cover. The cover's like a Ralph Lauren sweater thing with the American flag on it torn away. And what I would really emphasize to our international audience, the Bill of Obligations is not just an American book. It is an international book about learning the civics that we all know. I love it. Eddie Glaude says here, democracy is more than procedures and laws, an ethical ideal. And Lisa, that sums it up for
Yeah,
us.
well, and also knowing each other other than just what people say in your vacuum in the social media sphere. And that's important, you know, how bifurcated everybody's news streams have become.
I mean, at home, they keep a calendar check on every 90 days. I start screaming about lazy-ass kids who go, how can we stay informed and all that? And I go nuts. I say, it takes work. Well, you have to work at it.
I actually was having a conversation with someone who is in my home about the potential influence that they get from the media that they read on TikTok or Instagram. And they told me, you know what, it's not a big deal. I can discern what's, you know, manipulative or what's potentially influencing me in one way or another. Really? I mean, honestly, this is some of the questions that need to really be discussed.
We got to get ready for next week, a Fed meeting and earnings. As you mentioned earlier, important earnings about the pulse of what America does best, which is technology.
Big tech parade. We got Amazon, Apple, and Google, or Alphabet, as some would call it, on Thursday.
We continue forward on this Friday, and very importantly, in 64 minutes, key economic data. Stay with us on radio, on television. This is Bloomberg Surveillance.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Live from the City of London for our audience worldwide, with equities on a back foot, down 0.4% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Minutes away from the opening bell. Coming up on the program, chipmaker Intel delivers one of its gloomiest outlooks ever. Republicans discuss kicking the debt ceiling can down the road, and looking ahead to Fed Chair Jay Powell taking center stage. We begin with the big issue. The cracks in tech get bigger.
For the big tech stocks, big tech earnings.
There will be winners and losers.
Microsoft is talking about a weak global backdrop.
Intel is in a very, very difficult position.
Tesla has no demand issue, but part of the plan is to keep taking prices down.
The cost cuts can only get you so far.
The message we're getting from this particular sector is that growth is slowing.
Some of the tech names, have become a lot cheaper than they were.
We're continuing this process of reevaluating valuations.
But I'm not sure that that's going to continue.
Let's not break up the champagne glasses at this point.
There's a lot of work to be done.
It's all the other companies that have yet to report.
Let's start the conversation. Joining us now, Morgan Stanley's Lisa Shallett, Peter Cicchini of Exonic Capital. Lisa, first to you. I'm looking at Intel, dreadful forecast. I'm looking at Microsoft this week, deceleration ahead. Are you hearing exactly what you expected to hear from these tech firms?
Actually, I think it's a little bit worse, but it's directionally confirmatory, Jonathan, with, I think, where the folks at Morgan Stanley have been, which is that there's definitive risk to the earnings profile as both pricing power and volumes decline, coming off what has been a historic stimulus over the last 2.5 years and a pull forward in demand. We used to say, that, what happens to GM happens to the U.S. economy. I would say we're in a world, given the ubiquity of semiconductors, that what happens to Intel happens to the economy.
Well, Intel's getting battered right now, and we'll talk about it in just a moment. Your words, Pete, I want to use your words. In the first 3 weeks of January, equity markets have already rallied. How much more delusional can they become? Can you answer your own question?
Well, it's the hardest question to answer. You know, there's one of the most massive disconnects I've seen in my career between bond markets and equity markets at the moment. We have a deeply, deeply inverted yield curve, which I don't think is emblematic of a dovish pivot. Rather, it's emblematic of a recessionary environment, which just about across the board, early earnings reports have been showing, from Sherwin-Williams to Microsoft to Intel, and the equity market has been ignoring it, I think largely because of early year flows, but also because a handful of tech names tend to dominate, you know, the NASDAQ and the S&P. We all know who those are: Tesla, Apple, and I think that's likely to change. I would say perhaps over the next month or so.
Well, look at these year-to-date moves already. The S&P up 5.75% year-to-date. The CSI 300 over in China year-to-date up 8%. The Euro Stoxx 50, everyone seemingly on board year-to-date up almost 10%. The outperformance comes from the NASDAQ 100 up by more than 10 full percentage points. Now, Lisa, I want to bring you on this. You can learn something from the incoming information, and you can learn something from the way the market responds to that data. What are we learning in terms of the market response?
Well, we're learning right now, you know, to the points that have been made, is this is a investor-driven market where folks want to view the glass as half full. They want to look through the bad news and hope for better days. And their view is, you know, the hope for better days is that somehow, you know, the Fed is going to miraculously start cutting sometime soon, and that's going to be the panacea for everything. We are in the camp, as you know, that suggests that is a little bit too much wishful thinking, and that a lot of what's really gone on here in the first 4 weeks of the year is much more emblematic of flows. We have seen since October a massive global easing of U.S. dollar liquidity. How often do you see commodity prices round trip at the same time that the U.S. dollar is down 11%, at the same time that the United States Treasury stops issuing and sucking liquidity in, at the same time that the Bank of Japan is contemplating the end to yield curve control and the end to their bond buying program? How often does that happen? Never. And so we have seen this easing of financial conditions that is spectacular. It's flying in the face of what the Fed is trying to do. And I think it's all money flows that are driving this market right here.
Pete, I want to give you the opportunity to weigh in on this as well. Why isn't the weakness of last year just last year's story in tech? Haven't we priced in enough of weakness into this sector already? And what are we seeing on the screen right now? Why isn't that a challenge to your view?
Yeah, no, I think not. I think the repricing of risk assets last year came primarily from the rate shock and the adjustment that had to happen to PEs. And this year, really, and we're in the midst of this odd, awkward transition from market participants sort of absorbing the impacts of the new rate regime, and transitioning to this idea that the real economy and earnings are really the next catalyst for the leg lower in equities and high yield bonds as well, corporate bonds, in our opinion, this year. So that transition takes time because, you know, there's a lot of exhaustion relative to the bearish view at the moment. So I think it's partly that. But that transition from a sentiment standpoint, I think, is taking some time. But at some point, bad news will become bad news rather than something else. And I guess lastly, I'd say the Fed has been very clear. In its last statement, it said there was an unwarranted easing of financial conditions. I think that makes it pretty clear that the Fed does not want to see equities back at 4,400 on the S&P.
Well, they're down this morning. 24 minutes away from the opening bell. We're down a third of 1% on the S&P. On the NASDAQ, we're down a half of 1%. Intel down a whole lot more. Kaylee Lyons has the story. Hey, Kaylee.
Hey, John. Yeah, no surprise Intel is down now about 9% before the opening bell after what was frankly just a really, really bad forecast. One analyst over at Bernstein called it astonishingly bad. They are actually forecasting a loss for the current period of about 15 cents a share. Analysts were expecting a profit of 25 cents. Plus, when you look at the range of the revenue guidance at the low low end, it missed by billions and billions of dollars at $10.5 billion, which would be the lowest total revenue for any quarter going back to 2010. So this is just really grim, and it speaks to the downturn specifically in demand for PC chips, which is Intel's main business. And as a signal, that slump is likely to continue this year. That's weighing on fellow chip makers like NVIDIA and AMD. They're down about 1.5% and 3.4% respectively in pre-market. And then KLA Corp, which gave its own disappointing forecast today, is down by about 4.4%. This is in keeping with the other misses and punishments we have seen in the chip sector so far. Wolfspeed fell about 6% after giving weak guidance yesterday. We saw punishments for Texas Instruments and Micron as well. And even one of the outliers here, Lam Research, which actually rose yesterday after its results, the forecast was still weak. Perhaps you can attribute that gain to the fact that they are cutting 7% of its workforce. And that's probably a saving grace, considering we have seen investors reacting positively to job cut announcements in the tech sector. And we know, John, there has been a lot of those, many of them coming from the mega caps themselves, more of which will be reporting next week. Meta is reporting on Wednesday. We're expected to see a revenue decline of about 6%. Then Amazon, Apple, and Alphabet on Thursday. Just those four companies together representing roughly $5 trillion in market capitalization, which of course is a whole lot less than they used to be, collectively worse. And we're going to get more insight, John, into how the slowdown in the economy is affecting the revenue growth of these once, and I stress once, super high growing companies.
A massive week of results coming up next week. Looking forward to your coverage of it, Kaylee. Thank you. Intel getting absolutely slammed going into the opening bell. Here's the take from Barclays. This is an interesting one. They say this: Q4 results confirm what everyone seemed to have expected: slowing demand, margins pressure, and uncertain outlook for 23. But they're not a shocker either. They go on to say the Fed and ECB meetings next week may matter more for the near-term fate of the equity rally than earnings. That from Barclays. Lisa, you say it's best to lose the obsession with the Fed. So what would you say back to that note from Barclays this morning?
Look, I think, given the rally and given my comments on financial conditions, I do think that next week's meeting does take on significant importance. I am in the camp that says, that Chair Powell is going to push back aggressively around this bullish narrative, or this idea that they're going to cut anytime soon. I agree with the points that have been made. I do not think that this easing of global financial U.S. dollar liquidity conditions is what he wants to see at this point in the cycle, and I think it's going to keep them leaning hawkish.
Pete, why aren't actions louder than words? This is another downshift. Most people expect 25. Why aren't actions louder than words?
Yeah, if the Fed really wanted to accomplish what it says it wants to, it would do 50 in the upcoming meeting. I do think this is a pivotal meeting. I don't think they will do 50. I don't think they have that kind of resolve, mostly for that reason. But I also think they're cognizant of the fact that policy does work with long and variable lags, and there has been an extreme tightening of financial conditions, one of the most aggressive in history since the 1970s, and in response to some of the worst inflation we've seen since then, of course, so it's certainly warranted. But, it is prudent to slow the pace of hikes. What I think investors are missing is this long and variable lag effect. The economy is going to start to feel it this year. We're seeing it in the layoffs that are being announced. And the Fed is not going to react the way it normally does. I think they're misassessing where the Fed put is struck right now. It is not struck down 20% on the S&P 500 because of inflation, in our view. And I think that's what's being missed here primarily.
Lisa, the focus on the data makes sense, focus on the fundamentals. I hear that from you. But then I look at the fundamentals yesterday and saw claims at 186,000 and saw the way the bond market responded to it. Sure, yields were higher, but not materially so. Lisa, why do you think that is? Why is this market not responding to the way you think it should respond to the data?
I think we alluded to it. There's a lot of look through. There's a lot of ideas that somehow we're approaching a trough. And I was on a call this morning with someone, who was telling me, on the Microsoft earnings, hey, this is as bad as it gets. And, we were kind of pushing back and saying, wait a minute, we're getting these fourth quarter results against a backdrop where, fourth quarter U.S. GDP was just reported at 2.9% real, right? With inflation that we know is still running, between 5 and 6. So we're talking about, an economy that could be, nominally growing at 8. And this is what these companies are doing at 8. What are they going to do when we may get down, to 2 or 3? So, this look through this, the glass is half full attitude again, I think is being emboldened by liquidity and this sense that there is less liquidity pressure in markets.
Lisa, I think there's also a feeling that if you took a 12-month rolling view of the economy, that outlook over the last few months has improved, it's got better, not worse. Would you push back against that?
I think on the margin, it has gotten better, but it's gotten better for a lot of reasons, as we talked about, that are somewhat luck, right? I'm not sure that the European, view has materially improved because of fundamentals. I think, we got an incredibly warm winter, which has taken the boil off of some of the inflation issues. And we've gotten a, announcement of, potentially more aggressive stimulus coming out of China, which, folks have been talking about, for at least 6 months. So I'm skeptical of that view, right here.
Pete, can I come to you on the same question and just finish there? If you took a 12-month rolling view of the economy, has it got better or worse over the last few months?
Yeah, I would really echo Lisa's points. I don't think it actually has gotten better. But to the point about fortuity, oil prices have made a big difference. And there are a lot of reasons for that. China was slower to reopen. There was another month worth of SPR draw without replenishment. And energy prices make a lot of difference to the inflation story. And oil is creeping up and not going down, especially given the geopolitical backdrop and the layoffs that we're seeing this earnings season. I don't know how that can be ignored. Those are going to creep through quickly to claims over the next few months.
We'll talk about that in just a moment. Peter Cicchini, Lisa Shallett, sticking with us. Equity futures right now down 0.4 on the S&P. On the Nasdaq, which has been absolutely flying year to date and over the last week too. We're down a little bit, a bit softer, down 5 or 0.6%. Coming up, another player entering the debt ceiling debate.
The very notion that we would default on the safest, most respected debt in the world is mind-boggling. I will not let anyone use the full faith and credit of the United States as a bargaining chip.
That conversation up next.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
very notion that we would default on the safest, most respected debt in the world is mind-boggling. Look, if Republicans want to work together on real solutions and continue to grow manufacturing jobs and build the strongest economy in the world and make sure Americans are paid a fair wage, I'm ready. But I will not let anyone use the full faith and credit of the United States as a bargaining chip. The United States of America, we pay our debts.
The President of the United States slamming the GOP, House Speaker McCarthy calling him to the table, tweeting the following, quote, "If the President is so eager to speak, then he should set a date to discuss a responsible debt ceiling increase." This is signs that Republicans could kick the can down the road. Bloomberg's Anne-Marie joins us right now to discuss. AMH, let's talk about that right now. What are the chances this can happen?
Well, we don't know yet, right, Jonathan, because this is just a proposal right now within the Republican Party, according to people we're speaking to, but we're not sure yet if Democrats would go on board with this in Congress, whether even the White House would go on board with this. So basically, and Chris Kruger of Cohen actually outlined it. He said, build more land. That's an option. Kick the can down the road. But the issue is that in Washington, the can always comes back and you have to deal with it. But what this would do was just put off the risk of default until September 30th. For the Republicans, this could be a good negotiating tool because that would then align the debt ceiling talks specifically with funding the government, because appropriation bills, Jonathan, run out at the end of that month as well.
So, Anne-Marie, what kind of date are we talking about? I'm still trying to figure out this X date. Where is it on the calendar?
Well, it's interesting because you can't exactly place it from where we sitting are today in February to where it's going to be. When you talk to the likes of Mark Zandi, though, it's somewhere in the summer. So likely sometime at the end of the summer. So really the talks are going to get very heated in June, and then that's going to last until August, unless they do kick the can down the road, and then it goes to the end of September.
AMH, thank you. The latest down in DC. Now, every time I ask a guest about this topic, I get a shrug of the shoulders, and here we go again. Lisa Shallop, Peter Cicchini, back with us to shrug their shoulders and say, here we go again. Peter Cicchini, is that how you feel about this issue?
Yeah, I think my response to you was ho-hum. Been through this. It's really unfortunate that the fiscal condition of our country is used by politicians in the way it is. Unfortunately, we are simply spending too much, but modern monetary theory has made it, frankly, acceptable in a lot of schools of thought. Perhaps now that we've seen this broader inflation, which was partially at least brought on by the deficit spending from the pandemic, politicians will be a little bit less hesitant to be profligate. But it will be resolved. It will take time. To the president's point, no one wants to be responsible for default. And unfortunately, that's one of the reasons why we go through this on such a regular basis.
Lisa, do you agree?
100%. I mean, this is pure politics, plain and simple. There is extraordinarily low odds that ultimately Treasury wouldn't find a way to pay all its debts and all its constituents. This is money that has already been appropriated by Congress, as has been discussed. And so, this is pure politics, and it is quite unfortunate because it just creates unbelievable amounts of uncertainty. And the other thing that it does is it really, pushes around Treasury strategy around their issuance, which again impacts market liquidity. So it's just unfortunate. It's another source of volatility for investors that, might have been avoided.
Yields this morning just a little bit higher on Treasuries. Not a big deal, that's for sure. I want to finish on this. You're both pretty bearish, so let's finish with a part of the market that you do actually like right now. Lisa Shallop, where is that part of the market at the moment?
So, we're looking at some of the deep cyclicals that have sold off. So we've started to get some moderation in some of the housing data. So we're looking at some of the home builders, some of the residential REITs. We do like some of the semiconductors down here that look like they're starting to put in cyclical troughs in the traditional sense. Some of the software services companies look interesting to us. So we would be there. Financials, healthcare, energy, industrials. We're finding stocks to pick here.
Peter, you get the final word.
Yeah, look, we're largely a structured credit firm, and so we're seeing opportunities in structured credit with high single-digit yields on over-collateralized bonds And we love that, especially versus corporate credit or equities. And when you think about where equity risk premium is, if you look at a 5% earnings yield on the S&P 500 versus 4 and change on the 2-year, there's no equity risk premium. So it's clearly not in equities. Collateralized cash flowing structured credit for us is really the place to be right now.
Pete, great to catch up, as always, alongside Lisa Shallett, going into the weekend and looking ahead to a massive week ahead with central banks on deck, the Federal Reserve, the ECB, and a ton of earnings as well. Coming up, the morning calls, and later, Intel forecasting one of the worst quarters in its history. We're looking ahead to a busy week of tech results with RBC's Amy Wu Silverman. Intel down 9.5%, equity futures down 0.4%, and the Nasdaq 100 softer by about 0.6% year to date. Absolutely flying. Your opening bell, 7 minutes away.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Away from the opening bell, equities down just a little bit by 1/3 on the S&P. On the Nasdaq right now, down 0.5%. Let's get you some morning calls. First up, UBS upgrading General Mills to buy, $88 price target, highlighting the company's consistent free cash flow and improving balance sheet. That stock up by 0.9. Next up, BMO downgrading Ralph Lauren to underperform, seeing limited upside with margins under pressure. That stock is down 3.4%. And finally, Argus upgrading Las Vegas Sands to buy, $68 price target, expecting the company to benefit from the end of China's strict COVID rules. We're positive there by about 0.5%. Coming up on the program, RBC's Amy Wu Silverman seeing demand for downside protection ahead of a monster week of big tech results. That conversation just around the corner. Futures negative 0.3%.
typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities
Could face bigger challenges next. Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We are about 22 seconds away from the opening bell. Let's get some price action briefly in the equity market. Equities right now down a third of 1% on the S&P. On the Nasdaq, which has been absolutely flying year to date and over the last week, was softer there, negative by 0.5%. The opening bell in New York City rings. Switch up the board and get to the bond market. Yields look like this going into a pivotal week potentially for the Federal Reserve. Going into that, yields just a little bit higher, up 5 basis points on a 10-year to 354.22. Dollar showing some strength, euro some weakness. Euro dollar down 0.4%, a break of 109 again at 108.50. And looking elsewhere at what's happening with crude, WTI, $82 and about 15 cents, positive there, 1.4%. We are about 20 seconds into this. Equities are lower by 0.25% on the S&P, on the Nasdaq down by 1/3 of 1%. One stock to watch at the open, it's Intel getting absolutely hammered. The chip maker reporting misses across the board and issuing a pretty grim outlook. The CEO saying this: given the continued uncertainty, we expect PC consumption to be on the lower end of our estimates this year. That stock hammered on the West Coast. Here's Ed Ludlow.
Good morning, Jonathan. The stock down 10%, a significant drop. And what was so interesting in the sell side response is that even against extremely low expectations for the first quarter forecast, this was a surprise and an astonishing forecast from Intel. Let's get straight into the numbers. A forecast for adjusted sales, $10.5 billion to $11.5 billion in the first quarter. But even at the top end of that range, you're still $2.5 billion below the consensus estimate. A surprise forecast for an adjusted loss of 15 cents a share. The street was looking for modest EPS of 25 cents, but we point out in the Bloomberg story that on an adjusted basis, at least, this is the first prediction of a loss in a quarter that Intel has made in decades. The story in its end markets, Jonathan, is very clear. Look at PC and desktop demand. Look at data center. Both account for almost 80% of revenue, both dropping year on year, more than 30% in terms of that quarterly revenue change year on year. The message from management is bear with us. Of course it is. Look at how Intel shares have performed since 2021 when Pat Gelsinger returned to the company and took over as CEO. At that time, it was the top chip stock. It's lost its crown since then to NVIDIA, but they look like there are no signs of that ever coming back. And Gelsinger on the call, John, made a pretty clear point. I'd like to remind everyone that we're on this multi-year journey. We're more than a year into the multi-year journey. I guess the question for the street is how much patience have you got for that journey?
Maybe not much based on this morning's price action. Ed, thank you for that. Intel down by 10 percentage points. We've seen some bad tech earnings so far this earnings season, but tech, the Nasdaq, if that's how you capture tech, has performed tremendously well. We are only down about 0.2% right now, and year to date we're up about 10 full percentage points. Michael Hartnett over at Bank of America published this morning. Here's a quote for you. This year tech has been playing catch up, rate cuts, dollar down, job cuts for margin, speculation has returned. He calls it the pain trade. The pain trade has been higher to 4.1 to 4.2K on the S&P 500. Right now 40.53 on the S&P. He goes on to say, after that, after you get through 4,200, after that we sell, as we now are close to the moment where stock gains start dragging yields higher. That from Hartnett this morning, something to think about anyway. Here's another name for you, Amex, painting a very different picture to Intel. The firm forecasting a surge in revenue after record card spending. The CEO saying it's, quote, in an even stronger position today than before the pandemic. This as competitors saw slower than expected spending in the last quarter. Let's get to Abby for more. Hey, Abby.
Hey, John. Yeah, this is an interesting one. And as you mentioned, the stock is surging its best day in about a year. This after that record spending last year. Now, interestingly, the quarter that was a little bit messy on the surface, but that outlook, it's all about the outlook, the fact that consumers are spending so much, the idea that they were able to boost their ranges for pretty much all metrics in a big way. Relative to earnings, they're looking at a range of $11 to $11.40 for this year versus the estimate of $10.43. They're looking for revenues to rise 15 to 17% versus the 11% growth estimate. So really all systems a go. Now, it has to do with that consumer spending. It's really interesting because during the pandemic, at the beginning of the pandemic, we saw credit card spending really plunge to less than $1 trillion. Now we're at a record high, closer to $1.2 trillion. It seems as though with the inflationary picture, some folks have also been using credit cards for essential needs, not just the nice to haves. Now, relative to the recent rally, we have the credit card company stocks doing really quite well, up as much as 11% into the open. I'm guessing that American Express up much more. There you go. Well, up right about 11%, taking that spike, outperforming the financials overall. Now, American Express, John, is a part of the financials, but Visa and MasterCard, those stocks up close to about 10%. They are actually a part of the technology group, so there's another piece of that tech rally that we can't get away from this year.
Abby, thank you. Amex up by 7.4% this morning. Abby, thanks for that. Chevron is down by 2.75%. It's a miss for the oil major. Disappointing fourth quarter results coming just days after announcing a monster buyback program. Here's Katie Lyons with more. Hey, Katie.
Yeah, so John, this loss of nearly 3% at the opening bell this morning is giving back some of the gains that were made yesterday when the stock rallied nearly 5% after that $75 billion buyback announcement. So a little bit of that optimism from Thursday is not filtering through to this Friday on that disappointment. Revenue did come in ahead of expectations, but net income came in light and profit of $4.09 a share fell short of the estimate. Now, part of that is just the fact that oil prices have come down, but another part too, according to analysts over at RBC Capital Markets, and we'll have to excuse the fire alarm going off here in the U.S. John, hopefully you're not hearing that in London, but you have corporate costs as a factor here, and the outlook came in light as well. I would just note, and I'm going to wrap it up because this is really loud over here, Chevron did have a record year of profit in 2022, and we know, of course, that has drawn political ire. They would like to see them investing more in output, not buybacks, but we know Chevron is trying to do both, John.
I'm hoping this is a drill, but you should probably run. Katie Lyons, thank you. Only Katie could remain that calm in the face of a fire alarm going off. I assume that's a drill, and hopefully for Katie's safety, it is one, and I'll confirm it is one in a couple of minutes' time. Equities right now down 0.2% on the S&P 500. We are about 6 minutes into the session. The Nasdaq is negative by 0.15%. RBC's Amy Wu Silverman seeing a shift in investor behavior and writing the following. We came into 2023 underhedged, underinvested. We're starting to see this change somewhat, seeing renewed demand for downside protection. Amy, I'm pleased to say, joins us right now. Amy, great to catch up with you. You said in your notes that you've published recently that this is the boy that cried wolf market. Can you tell us all what you mean by that?
Sure. Good morning. So, look, when you look to last year, the S&P drew down 20%. And the only option strategy that did worse was if you owned the S&P and owned puts, you managed to be down 21%. So, it was pretty unlucky for investors who wanted to hedge, got the drawdown, and still managed to lose more money. And so people were burned. They didn't want to listen to any of the metrics coming up. And I think that's why we ended up in 2023 with the positioning that we saw. So I find it very interesting now, John, that we are finally starting to see this uptick in demand for downside protection that we didn't see at all during the drawdown last quarter. And we finally started to see that change.
So, Amy, you're saying investors are using this recent strength to reload on downside protection, and if they are, what are you advocating they should do?
Yeah, I would say two things. One more sanguine interpretation is that part of the reason we finally see this demand, John, is because people are actually becoming more invested in the market. So, there's only something to hedge when you've actually managed to make that money. The second thing I would say, as you start to get that uptick in skew, the options curve starts to structure in such a way that things like put spreads, which you and I have talked about before, look attractive based on their payouts. So, ahead of what is quite a monster week, both individually for stocks as well as for macro, and a VIX kind of sub 20, I think those trades look attractive.
Amy, can we talk about next week just quickly? How much of a risk event do you think that Fed decision actually is?
So, I think it's interesting because with PCE coming out as it did today, maybe that takes some relief into the market. But, to me, more importantly than even what the Fed will say is just the slew of tech earnings we're going to get. Because, if you continue to look at what the meat is made out of in the S&P and other ETFs, it's still, a handful of names, a handful of mega cap tech names. And sure, there was shrinkage in 2022. But if you look at that contribution return, John, from last year of that 20% drawdown, it kind of came down to 80% being, again, 7 to 8 mega cap tech names.
The longer this goes on, the more it hurts. But this rally in mega cap tech and the Nasdaq has been rip-roaring year to date. Amy, what are you telling your clients about it?
Yeah, I think one thing to keep in mind, and I was watching that Intel print as well, is, historically options can kind of tell you what the implied move is on earnings, but usually options don't actually beat their implied moves. The realized move on earnings, they tend to be lower. This has been the opposite really during the pandemic period. So, one name I would point to is Meta, which if you look on an 8-quarter basis, which is what most people do, it kind of looks like a fair implied move to earnings. But on a 4-quarter basis, this is a stock that realizes an 18% move in either direction on earnings, and it's only pricing in a 10% move right now. What does that mean? I think you own all implied moves by owning options. So, that can be to the upside or downside based on how your portfolio is framed. But right now, actually owning options pays far more during earnings season than it has in many past earnings seasons.
So we've addressed Fed, we've addressed tech earnings. Can we address China just briefly? This is one of these issues, and you've published on this, and it's important to recognize, it's one of these issues that actually provides us with upside risk. And Amy, I'm wondering how you're telling people how they should gain exposure and participate in the potential that upside risk really develops even further.
Yeah, it's interesting. I'll tell you one thing. This is an area where the options market was quite early. We saw folks buying upside in ASHR, Web, Baidu, FXI, months before the reopening. And every time I spoke to clients, they said, look, am I going to get burned? Is this a premium going to zero because China hasn't reopened yet? Maybe, but I have to participate. One thing I'll say is that's inflecting. We're actually seeing defensive positioning now. But two, for people who still want participation of China, I would actually focus on cheaper ETFs, maybe an EEM or single name Chinese ETFs like a Baidu, where that relative volatility hasn't priced in as much as something sort of more obvious like a FXI.
Amy, do you think the range of outcomes in the China story are wider than people give it credit for?
I do, and I've spoken to some folks where they were kind of long earlier, and now the inflection point has gone to more defensive. And, my question has been, what do you think is going to happen? It looks like, we're kind of full blast on reopening. And the risk people point to, the left tail risk is that if you look to the reopening that happened in the US or Canada, it wasn't linear, John. It wasn't like, okay, we reopened, the end. There were fits and starts. There were different variants that came up. There were kind of waves of lockdowns. And that's the concern right now, which is why I think, given how far we've run, some people are starting to get concerned.
We've run a long distance already, and I think we're only 3-4 weeks into this. Amy, this was wonderful as always. Amy with Silverman there, looking ahead to next week and beyond, in the case of China at least. We're about 12 minutes into the session. Equities are down by 0.2% on the S&P. On the Nasdaq, we're lower by 0.15%. That's the session. Year to date, equity markets have been absolutely flying. From the NASDAQ 100 all the way over to the Euro Stoxx 50, EM and China for that matter as well. Year to date, the numbers have been absolutely phenomenal. I mentioned Michael Hartnett of Bank of America, and when Michael publishes his weekly flow data note, he puts in there, heard on the street, and just a quote from a client or something like that. And this was the quote this week. I'll read it to you. Another 3 to 5% here will feel like bathing in lava if you're a bear. This is painful for a lot of people the last few weeks, that's for sure. Equities right now, then 12 or 13 minutes in, we're down about 0.1%. Coming up, the Fed and ECB releasing decisions next week after striking a hawkish tone back in December.
We continue to anticipate that ongoing increases will be appropriate.
We judge that interest rates will still have to rise significantly at a steady pace.
That conversation up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
The full effects of our rapid tightening so far are yet to be felt.
More needs to be done.
Ongoing increases will be appropriate.
Risks stem primarily from domestic factors, inflationary pressures.
Inflation remains well above our longer run goal,
the 2% inflation target.
I wouldn't see us considering rate cuts
for a period of time
until the committee is confident that inflation is moving down.
Interest rates will still have to rise significantly.
There are not rate cuts in the SEP for 2023.
That was the message in December, a recent deluge of economic data and better than expected data, now setting the stage for both the Fed and ECB next week. Those rate decisions front-running the US payrolls report on Friday. Team coverage begins right now with Bloomberg's Mike McKee in New York and Guy Johnson over in London. First to you, Mike, your thoughts on this Federal Reserve next week and what we need to look for.
Well, I think the numbers that we got today, and excuse us, there's a bit of a fire alarm going on in the background here. Numbers we got today on inflation make it fairly certain the Fed can do 25 basis points. The PCE inflation numbers that they follow closely went down on a year-over-year basis. And so at this point, it looks like the Fed can do 25. The question is what happens when we get into January, and do those figures suggest the Fed has to start doing more again? But right now, it looks reasonably good.
Chaos in the New York studio, Mike McKee. I'm not sure if you've got a run to be in this fire drill either. Mike McKee there, over in New York. No one seems to have a clue. Guy Johnson with us here in London, where there are no fire alarms, guys. So we're good, I hope. The ECB, it took me by surprise in December just to see ECB President Christine Lagarde as hawkish as she was. I think the most hawkish you and I have ever seen her.
Yep, and it's continued. That's the message. It has continued through January. We heard it at Davos as well. The World Economic Forum message was very hawkish. The message coming consistently from most members of the ECB is that we will see a 50 basis point hike at the next meeting. There are a few exceptions. The real question, John, is not what happens at this meeting that's upcoming. It's the signaling for the next meeting and the meeting after that I think everybody's going to be watching out for.
The Doves are trying to be heard. I imagine there's some real division on that committee now.
Yeah, but the balance is firmly in favour of the Hawks, and the Doves are going to struggle. There was a long period of time when the Hawks weren't heard. We've completely flipped that on its head now. There aren't that many Doves out there either. Clearly, the Portuguese, the Spanish to a certain extent, the Italians, and the Greeks. But the amazing thing is that BTP spreads are being well behaved. And in some ways,
I'm surprised.
I think a lot of people are, and that is in some ways giving the green light to the ECB to do more. The market is signaling that it's comfortable with what is being priced in right now, and it opens up the possibility of further signaling as well when it comes to QT.
I keep saying this, I was shocked that we managed to get to 250 at the ECB without absolute chaos in markets, and now people are talking up, what, 350?
Yeah, I think that's being seen as being kind of where the market is. I think that is the expectation. Whether we get that far remains to be seen, because when things change, they change fairly quickly. We'll wait and see whether or not that ultimately is the destination. I do think, though, that while the destination is increasingly important, what we haven't had from the ECB is all of the details on QT, and I think that's kind of where I think the focus may become.
Let's talk about the destination for the year ahead for Europe. I've spent the week here, Guy. You've heard the same voices tell you the same things, which is that the ECB can hike more than the Federal Reserve this year, just in terms of the additional rate hikes. Maybe they don't get to 450. Who knows? I'm struck by the war in Ukraine still continues.
Yep.
I'm struck by the fact that it looks like it's escalating based on the fact that tanks are now going to be arriving in Ukraine in the next several months, and there's a conversation about maybe jets following. I have no idea where we are on that. I spoke to Amrita Sen earlier this morning of Energy Aspects about whether Europe could repeat the act that it managed to perform in the last 6 months, which was build up storage levels, build up capacity, build up gas storage, preparing for winter. Can they repeat the act for next winter? And she said she doubts it. No.
It's interesting because a lot of people do think that is now possible. They think that Europe is going to be coming out of this winter with significantly higher storage levels than is normally what would be seen. In some ways as well, it's about price. This is not a supply shock for Europe. It is a terms of trade shock. It is about how much you have to pay for the gas. And I think that is the critical difference here as well. It does come back down to China. What happens with China and its demand is going to be crucial in terms of what happens here. The weather, as we all know, is going to be critical. The big surprise this year has been around the weather. It's been Mother Nature that has provided the biggest surprise here.
Sure. Throw in a bit of coal as well.
Okay, throw in a bit of coal as well. That was already kind of there and ready to go. The fact that we've had to use it, maybe less than anticipated, I think is probably the bigger shock. And I think you've had a really interesting story this year. Can it be repeated next year? I don't know. Give me a long-range weather forecast and I'll probably be able to tell you.
Yeah, I'm not a meteorologist. I'm not sure a meteorologist is any good at that either. No. Guy, this was great. Am I seeing you in the States next week?
Yeah, I'm going to look forward to seeing you in the States. I've got to go via Seattle to the handover of the last 747
emotional.
On Tuesday.
Emotional. For you, not so emotional for me. Guy, I'm looking forward to the conversation, though. Great interview coming up next week. Look out for that. Guy Johnson's going to be with us stateside. I'll be there as well with Michael McKee, counting you down to that Fed decision. I can confirm that there wasn't a real fire. It was somewhat of a drill, if you want to call it that. Okay, about 22 minutes into the session, equities positive now. On the S&P by a tenth, on the Nasdaq by a third. Let's get you some sector price action. Here's Abby.
Hey, John, and yes, much quieter here, although there was a moment where we wondered. At this point, we do have the S&P 500 up slightly, up almost about 0.2%. Most sectors are higher for the S&P 500, led by consumer discretionary, up about 1%, communication services right behind. So we also have technology higher. Those mega cap packs once again leading the way. To the downside, we have energy, despite the fact that oil is higher, healthcare, utilities, and staples. So those defensive sectors, with the exception of energy, those are the ones on the downside. Now, we do also have stocks higher on the week. Surprise, surprise, up more than 2% relative to the sectors. Despite the fact that we have this Intel debacle, we actually have the stocks higher. We have the discretionary space higher on Tesla. To the downside, though, John, there are those defensive sectors. We really have investors going into growth quite strongly this year.
Abby, thank you. Up next on the program, your trading diary.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Equity markets turning around here about 25 minutes into the session. We're positive a tenth on the S&P, on the Nasdaq up a third. Let's get you the trading diary. UMich sentiment survey coming up at the top of the hour. Looking ahead to a monster week, a Fed decision and Chair Powell news conference on Wednesday, followed by earnings from Meta, rate decisions from the ECB and BOE on Thursday, plus results from Apple, Google, and Amazon. And finally, it's Jobs Day in America to round out the week. Here is your week on this program next week. What a monster lineup that the team has put together for you on Fed Day. Kathy Jones, Bob Michael, Chris Harvey, Mike Wilson. That's on Fed Decision Day. On Payrolls Friday, Mohamed Al-Arian, Rick Reeder, Anastasia Amoroso, Mike Collins. All of that coming up next week. Live from London, thank you very much for choosing Bloomberg TV. I'll be back with you in New York next week. This was the Countdown to the Open. Have a wonderful weekend. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about